have a large group here. We have a stranger in our midst in the form of Mark Siegel, but he's promised to behave, so you can speak up if you like. We have one person joining by conference line. That's Rajesh Gopinathan. Rajesh, are you there?
Yes, I am here. Hi, everyone.
Yes.
Good afternoon.
So he's reporting in from Mumbai. So Jim, over to you.
Welcome to the folks here as well. And issues on the agenda today. Ian, I think we're going to start with Cassidy providing an update on a number of projects.
Jim, you're a little bit in and out, so maybe you have to speak close to the microphone.
Okay, I hope we don't have that problem again.
All right. Well, thanks,
Okay,
Jim.
Cassidy.
The TRG has met 5 times since the issuance of the new revenue standard, with this being our 6th meeting. The majority of the implementation questions addressed at the meetings have been resolved at the meetings without any further action needed. However, standard setting has been required on a few of the issues. The staff provided a standard setting update at the July TRG meeting. Subsequent to the July TRG meeting, both the FASB and the IASB have issued final amendments to defer the effective date of the revenue standards by 1 year. The IASB issued a single exposure draft proposing several clarifications to IFRS 15. The FASB issued 2 proposed updates: principal versus agent considerations and narrow scope improvements and practical expedience, and redeliberated its proposal on identifying performance obligations and licensing. To date, the boards have discussed all of the topics that they had directed the staff to perform research on based on the TRG feedback, and I'll provide a brief update on those topics. First, I'll provide an update on identifying performance obligations and licensing. On October 5th, 2015, the FASB redeliberated its proposed amendments to guidance on identifying performance obligations and licensing. The board affirmed the proposals related to the re-articulation of the separately identifiable principal, immaterial promises in the context of the contract, and a shipping and handling practical expedient. In addition, the board decided that as a result of not identifying promised goods or services that are immaterial in the context of the contract, revenue is recognized before all of those goods or services promised in the contract are transferred to the customer. The related costs to transfer those goods or services should be accrued. The board decided not to make changes to the series provision and asked the staff to perform further research on the requirement to disclose the transaction price allocated to remaining performance obligations. Related to licensing, the board affirmed that an entity's promise to transfer a license to functional intellectual property is satisfied at the point in time the license is granted, and that an entity's promise to transfer a license to symbolic intellectual property is satisfied over time because the entity's promise to transfer a license to symbolic intellectual property because the entity's promise to the customer includes continuing to support or maintain the intellectual property to which the customer has rights. The board also affirmed its decision to clarify the scope and applicability of the implementation guidance on sales-based or usage-based royalties promised in exchange for a license of intellectual property, and contractual restrictions in licensing arrangements. The board expects that an accounting standards update will be issued near the end of the year. On July 30th, 2015, the IASB issued an exposure draft which included clarifications to the guidance on licensing and amendments to the illustrative examples on identifying performance obligations. The comment period on the ED ended on October 28, 2015. The IASB staff is now in the process of reviewing and analyzing the feedback received. Next, I'll provide an update on principal versus agent considerations. The FASB and the IASB made tentative decisions to the guidance to improvements to the guidance on principal versus agent considerations at a joint board meeting in June. The IASB incorporated those decisions into its exposure draft of clarifications to IFRS 15, and the FASB included those decisions in a separate exposure draft. The proposed amendments include clarifying that control is the determining factor in the principal versus agent evaluation, the unit of account for the evaluation, the application of the control principle in the context of services, the role of the control indicators, and the application of the guidance through amendments and additions to the illustrative examples. The amendments in IASB and FASB proposals are converged. The comment period on the FASB's exposure draft closed on October 15, 2015, and the IASB's comment period ended October 28th. The staff of each board are now in the process of reviewing and analyzing the feedback received in preparation for a joint board meeting near the end of the year. Finally, I'll provide an update on narrow scope improvements and practical expedients. On September 30th, 2015, the FASB issued a proposed update on narrow scope improvements and practical expedients related to the new revenue standard. The proposed update is intended to improve the guidance on collectability, non-cash consideration, and completed contracts at transition, and would also provide a practical expedient for contract modifications at transition, and an accounting policy election related to the presentation of sales taxes and other taxes collected from customers. The comment period ends on November 16, 2015. The IASB decided to provide practical expedients for contract modifications and completed contracts. Those proposed amendments were also included in the IASB's July 30 exposure draft, along with other targeted amendments to IFRS 15. The staff think it is important for stakeholders to be aware that, consistent with the board's taking convergence of the new revenue standard very seriously, the staff of the FASB and the IASB continue to work closely together on all of the improvements proposed by each board, including those for which the words to date are not converged. The staff are closely monitoring feedback received on each board's proposal, and we are providing each board with information about feedback received on the other board's proposals. The implementation activities of the boards and their staff are very much a joint coordinated effort. Henry, do you have anything to add about the IASB's activities?
Thank you, Cassidy. No, just to reiterate that we have now received the comment letters on our exposure draft, and we'll be planning to have some substantive redeliberation discussions with the IASB at the December board meeting.
Okay. Anybody here got any comments on anything that's been reported? No, we're all clear, Jim.
Questions or comments on the status of deliberations? No? Well, I guess let's move on to the fun part of the day. We'll start you with an issue that I'm sure we'll have no discussion. You'll have the tee up on the staff paper, and we'll all just go on customer options. Nick, if you could give us an update.
Sure. I'm going to tee up all three issues separately, since there's a lot to talk about in each of the issues. So the staff received a submission on optional purchases with questions on when, if ever, the goods or services underlying the options should be considered part of the contract or simply evaluated for the existence of a material right. Additionally, at the last TRG meeting, in the discussion of the series provision variable consideration, some TRG members indicated that what the staff viewed as variable consideration may more appropriately be considered an optional purchase. So the questions at the last TRG meeting and broader questions on optional purchase really takes us to the first issue in paper 48. So issue 1 excuse me, discusses the difference between a customer option to purchase additional goods or services and variable consideration. So the staff think that the new revenue standard contemplates variable consideration that can be based on customers' actions, such as usage-based fees. And also the new revenue standard also clearly states that if the customer has an option that does not provide the customer with a material right, the exercise of the option is accounted for as an independent contract. Now, since both the exercise of the option and variable consideration can result from a customer's actions, it becomes challenging sometimes to distinguish between the two. So broadly, the staff think, as always, that it's first important to really identify and think about the nature of the promise to the customer in the contract. And from there, the staff then would consider whether the contract provides that customer with a choice or a separate purchasing decision. And then you'd think about the effects of the customer's actions. So does the customer's actions obligate the vendor to provide additional distinct goods or services, which may be more akin to an optional purchases, or do the vendor's actions effectively resolve uncertainty about the amount of consideration the vendor is entitled to really after or as control of those goods or services is being transferred? So in the paper, we tried to lay out how the staff thinks about some things and some examples and fact patterns and trying to distinguish between the two. And we certainly know that judgment will still be required, and it probably may not answer every fact pattern, but we really hope this just kind of narrows the gray areas that are out there and gives some direction that people can generally work with. Now, with that being said, I'll turn it over to the TRG members to discuss issue 1.
Observations, questions, comments? Allison?
Thanks, Jim. First, I wanted to say that I thought that the paper was very well done, and I think it is going to help move the ball forward on this issue. And I think that the arguments that were outlined by the staff in the paper are consistent with how we've been thinking about distinguishing between when something is an option versus when something is considered variable consideration, really looking at the nature of the promise. And the paper, or at least the discussion in issue 1, provides a framework that I think can be used to then evaluate more complicated fact patterns. I know that for some industries, and if we take the supply agreement example that's described in the paper, I think that now with this framework, fact patterns similar to the supply agreement example can move forward to evaluating not so much is it variable consideration or is there an option, but now the focus will shift towards let's think about the options in the contract. And in certain fact patterns where you might have a declining price happening over the term of a contract, then the evaluation now is going to be focused on whether you have a material right in the contract or not, and that's going to be something that's a matter of facts and circumstances and will require the use of judgment. But I do think that issue 1 provides a framework to at least help companies be steering in the right direction and focusing on the correct issues.
Yeah, I thought the paper did a good job of kind of maybe reining in some of the more extreme views. I do think and still worry that we took the stand ready obligation notion too far in the last meeting, and I think this question that we just went through was really dealing with the implications of that. And I worry that that's still going to continue to be a problem. So, I don't know at what point do we go back and rethink some of the discussions that we had on that question, the stand ready obligation, or does this do enough to kind of rein in some of the more extreme views? Maybe it does.
Yeah, I'm in agreement with Allison. I think this was well written and as well as it could be. I think it's still going to be a fine line, like Nick said, on when you have this. But I think the ultimate conclusion comes down to sort of the customer already make the decision to purchase the thing. I know the nightclub one's sort of a stretch, but I don't know whether any of our clients have that situation yet, but I think that sort of illustrates that the purchase has been made. The customer's already agreed to buy your service, and now it's just a matter of sort of drawing the line between those types of arrangements and like in the more complex situations. So I think this is fine. We had a lot of discussion internally about different situations, but Are we always going to get to the same exact answer on these? Like Russell said, probably there's going to be some where we're not, but hopefully the facts and circumstances will be laid out and supported and documented. And where companies want to estimate these purchases for the entire contract, they'll have to do it. But in others, I wasn't originally in the boat of. I thought a lot of these things, most of them were optional purchases, but this paper sort of convinced me otherwise.
Russell, I just wanted to go back to the point you made of stand-ready obligations and whether people were thinking about that maybe too broadly. And if you have specific fact patterns, obviously feel free. I mean, we can talk about them here, but don't need to. But is your concern that if you take that to its extreme, anything could look like a stand-ready obligation, just a normal, what people would have thought of supply contract, say it's not one where you would otherwise be recognizing over time, and somebody says you're not really providing me goods, your promise is to stand ready to provide me goods, and therefore it's really a service, not a good. And if you took that to its extreme, is that sort of your concern?
I think that's right. What I was thinking of was our maintenance and service contracts, where there's a lot of activities in those contracts. One of which is a stand ready obligation, but that's not the predominant element of the contract. So for that to drive the accounting, I think is what I was concerned about.
Russ, could there be situations where that is the predominant, I guess? I know in your broader ones you have a pretty good idea of where, the big ones, but I guess if you're a smaller manufacturer, not necessarily the engines, but you're literally standing ready in case anything breaks, almost like a warranty.
More of a warranty, yeah, that's right. Yeah.
Gotcha. So I think your concern was making sure we don't go too far and identify everything as stand ready, and then the units are really just the factor that determines total consideration, and so therefore it's not an optional purchase.
Right.
Don't go too far on that.
That's right.
Yeah, and I think that's that's part of the reason why we had that supply agreement example in issue 1, is to illustrate that, there are situations where through the contract you might have a lot of contracts have some sort of stand ready notion to it, but we didn't think that was necessarily the nature of the promise in all facts and circumstances. That is part of the reason we had that in there.
Sorry, Jim, I'm not real big on sharing, but I guess I'll work with it. I think part of, maybe to your point, Jim, is like if we took an example, you took like the health club and you said, okay, I joined the health club for 1 month, I pay $100, that's all I pay. I think we all say, oh, that's a stand-ready obligation. If I could join the health club, let's just say I'm only going to pay each time I go to the health club. Well, it's the same underlying service, but people get caught up, well, if they're standing ready with the health club, is that variable consideration? I think we all say, no, that's not a stand-ready obligation, that's a service. Some of the issues come to, well, what if I pay $10 to join the gym and $10 per visit? Now, is that a stand-ready obligation, or is that really an optional purchase? This paper doesn't really solve that problem. I'm not sure it really can, but I think that goes. Some people want to oversimplify and say, well, every service is a stand-ready obligation. I think my example illustrates that that's not necessarily true. Similar people want to say every good is not a stand-ready obligation. I haven't really come across one where I think it would be, but maybe there is one out there. So I think we just have to probably accept that we've done as much as can be done, and now, judgment has to be applied.
And I wonder if, in your tee-up, Nick, when you talked about the contract and the terms and the nature of the underlying, even in the gym example, if you think about, is it the same promise when it's, you'll pay $10 each time as opposed to you've paid up front and you just walk in the door? Tom?
I thought our conversation several meetings ago about snow plowing is a good example of how to think about stand readies. Russ's snow plowing contract, he pays up front at the beginning of the season, and for whatever price it is, and whenever it snows, they have to show up. That's a stand-ready obligation. I don't do that. I pay and I have a bigger driveway than he does. But I pay every time when it snows, I pay if it snows and they plow it. That's not a stand-ready obligation. That's a payment for services provided each time. And I think that's a useful way to begin to think about stand-readies versus others. And yeah, there might be a little bit of an upfront payment, but I don't think that's the nature of the promise. That upfront payment isn't for stand-ready. It's for processing membership or something else that's going on. But it is a judgment that is there. And every upfront payment, every payment doesn't give you stand-ready.
Others here? Ian, over to you.
Good, thank you. Any comments here on issue 1? Anybody standing ready to make a comment? Yes, Andre.
Yeah, we have problem with the example. Actually, in agenda reference 39, this example of the IT seller who is offering the server capacity, is a standard arrangement, and also managing the customer software portfolio. Now, in 39, it was concluded that, I'm reading the last paragraph, that there is a single performance obligation that is satisfied over time because the customer simultaneously receives, etc. So the conclusion was that it is a single performance obligation. Now, if there are multiple standard offerings, and if all of these offerings are satisfying the conditions, terms and conditions of 27 to 29 paragraph of the standard, will you still say that the entire contract is a single performance obligation? And the sentence was qualified by putting on the first word was assume. So we interpreted that, okay, for the purpose of this particular example, I am assuming that this entire contract is a single performance obligation. Now, in agenda 48, paragraph 30, we are writing that the staff understands that stakeholders have questions regarding contracts that have a stand ready element. The staff did not intend at the last TRG meeting to imply that all contracts with a stand ready element to them include a single performance obligation that is satisfied over time. So therefore, the confusion which could have arisen in 39, agenda 39 has now been clarified that yes, there could be a situation where even though it is a standard, but it could be multiple performance obligations. But by the time we come to paragraph 31, again the staff view the type of arrangement above as being a single performance obligation. So to us, it is a sweeping statement. Having stated in paragraph 30 that there could be a situation where it is multiple performance obligations, 31 is going opposite to 30. And finally, the economic value analysis of the contract and with an analysis of the contract with reference to para 27, 29, read with the IL, read with the BC, will determine whether this is a case of multiple performance obligation or single performance obligation. Such general kind of example, on the basis of such general kind of example, a specific conclusion cannot be drawn.
Ian, could I just check one thing with Barindra? When you said at the beginning you were talking about 39, do you mean the agenda paper 39 from the July? Okay, I just want to check.
Absolutely, because the example is same.
Mm-hmm.
But incidentally, in 39 they said assume. That means for this particular example, we made an assumption. Mm-hmm. So we are qualifying that this assumption is specific to the example. Mm-hmm. But by the time we come to 48, nowhere it is mentioned that this assumption is specific to the example. So that means it is a general rule.
Yeah, we do have to keep in mind that the examples are illustrative and don't draw a firm conclusion, I don't think. Carl.
Thanks, Ian. I also think the paper provides a very helpful insight in this issue. And my sense, master service agreements, in most of the cases I'm aware, and I did my own small outreach, in general do not contain material rights, and therefore I fully agree with staff's conclusion. And I think the opposite view, it's rather abstract to provide a proper accounting entry for the business in this study. I believe there is sufficient guidance in the standard.
Anybody else? Tony.
I think similar to others, Ian, I think my sense is that this is a difficult area, and I don't think there can be a one-size-fits-all answer. I'm still very comfortable with where we got to at the last meeting, but I don't think that means you would automatically treat those arrangements as being a stand ready, the same way I don't think you'd automatically treat other arrangements necessarily as not being a stand ready. What I think the paper does is give us an effective framework for the sorts of things that we need to think about when we're making those judgments. I don't think there's a bright line between arrangements that go one way or the other, but there's always going to be an element of judgment and being pushed towards thinking about the nature of the promise, thinking about whether the additional goods and services are in fact distinct, I think is a helpful framework. I think taking the paper together with what's in the standard probably gives us enough to work with.
Okay. Further thoughts? Yes, Mark.
I thought the paper was very good. I thought it was very helpful to give a nice reminder about step 2 having to be performed and understanding the promises that you've made in the contract and how that fits in before you even get to this question. As I was going through the examples, I found myself thinking through what is the obligating event that forces the seller to do more work? Is it the original contract, or is it a customer action that's causing the additional work? And that helped me think through the nature of the promises, et cetera. If the obligating event was the original contract, then it was one thing. If it was a customer action, then it was potentially an optional purchase. The only one small nit I had in the paper that I didn't want people to focus too much on is in paragraph 27, which references a customer action that results in additional payment. And I just didn't want people to focus too much on the payment, on the cash flow aspect of it, because I think payments are always going to be just sort of an attribute of whatever the payment structure is and of the contract, and really it's about the rights and obligations. And so that was the only part that I just wanted to
I must say I had a question mark against that as well.
Me too.
Brian.
I agree with the comments that going through the process of the discussion last time and going through this paper has certainly clarified for me how to think about these arrangements, albeit I think the distinction remains inherently judgmental. In response to Berinda's comment, I guess the way I was reading 30 and 31 is that, on the one hand, quite a lot of arrangements have some degree of stand-ready obligation in them, and perhaps some people might have come away from the discussion last time thinking that it was sufficient to identify some element of stand-ready in order to get into variable consideration, whereas I think the thing that's helpful about this paper is the clarification, in my mind at least, that lots of arrangements have some stand-ready element to them and something else going on as well. So having identified the stand-ready obligation, it remains necessary to think about whether that's a reasonable characterisation of the arrangement as a whole. And I think in making that characterisation, there'll be things that will inform that judgment in different cases. And I wanted to pick up particularly on obligating event, because I think the obligating event will inform my judgment. I'm not sure it would absolutely be determinative. I can imagine in the transaction processing case, I might say, well, actually, I do need somebody to send me that month's data before I'm going to do something else. But the significance of the obligating event, would be quite interesting. So a helpful way to make the distinction, but I think it remains kind of very, very judgmental, and I'd still be looking at it on a case-by-case basis.
Yeah. Philip.
Yeah, I think I'm just going to echo what the last three people have said, but it's mainly to check that I've understood. What I take away from this paper is that this is often going to be a difficult judgment, and here are some factors to think about, but these factors are not individually determinative. Thinking about them will give you a better overall picture, and at the end of that, you're still going to have to make a judgment. If that's what the paper is saying, then I agree. That was the kind of the message I got from the summary paragraph at the end. Some of the discussion earlier on seemed a bit more black and white than that, and that's the main reason I'm raising this. I don't think it is black and white. I think it's still a judgment.
Yeah, that's right. Gary.
And just to ask Brian a question, or maybe it's vehemently agree. I agree with anything that's got a elongated arrangement has got a degree of stand ready, but I think for this purpose, were you thinking that, like the snowplow example, stand ready and they may or may not come, whereas in the IT outsourcing, they're standing ready every second, every day, because every second, every day you're delivering something. So to some extent, it's the frequency and the probability of events happening, I think, is a distinguishing feature. Would you agree?
So, I think that, again, that would inform my judgment, and in some way, I'm looking for. It's a question of degree, right, and I'm looking at some basis on which to decide on any given case whether the stand-ready obligation or the action that I take in response to a customer request, whether or not either of those is the more important or more dominant.
Simultaneously delivered and consumed, in the IT or the transaction process is ongoing, Yeah.
So the transaction processing, perhaps I put quite a lot of effort into setting the system up, and I'm putting quite a lot of effort into standing ready to process the transactions, and the incremental thing I do is relatively small. At the other end of the spectrum, perhaps for a supply agreement, I have had to put a certain degree of plant together, and I have to have that plant in order to be able to offer the ability to fulfill optional purchases when they come through. But the main thing I'm doing is responding to the purchase order and putting everything in motion and doing the thing itself. And it seems to me there will be a bunch of fact patterns in the middle for which there is an element of judgment.
Okay. Further comments? Right.
Can I make just one?
Yeah, sure.
See, there could be multiple permutation and combination. There could be a multiple number of standard arrangement. There could be a combination of standard arrangement and overtime delivery arrangement, and various multiple combinations. The point I was trying to say is that depending on the nature, I don't think the quantity will matter. Depending on the nature, we apply the principle laid down in the standard 27 to 29, and then decide whether it is multiple or single performance obligation. Whether it is single performance obligation or multiple performance obligation is one subject, and how we treat variable consideration is another subject. These are not to be, it is not necessary that something has to be single performance obligation in order to talk about variable.
I think from what I hear, there's general agreement with that sort of position. Anybody violently disagree with that? Good. Okay, Jim. Issue 2.
Issue 2.
Okay. So at the October 31st, 2014 meeting, the TRG discussed paper 10 and issues related to termination clauses in a contract. So at that meeting, the TRG members generally agreed that the existence of a substantive penalty that compensates the other party was evidence that a contract exists through the period that that penalty was in place. So that paper focused on contracts where each party had the unilateral right to terminate the contract. However, the staff has received additional questions on fact patterns where only the customer has the termination right and the effect of that penalty compensates the other party upon termination. So in these situations, the staff understand there's two primary views. One is, view A, is really the existence of that substantive penalty, really consistent with the last discussion, provides evidence of a longer term or an effective minimum quantity. And view B is that the termination right and substantive penalty should be treated as an option that provides the customer with the material right. So ultimately, the staff, we just didn't see enough of a distinction between fact patterns where only one party has the termination right and the contracts that were discussed in paper 10. So that's why we agreed with view A and really think it's consistent with the discussion at the last meeting. However, I do want to point out that we do think it's very important for people to read issue 2 of this paper in conjunction with issue 10 of that paper, because that discusses a little more broadly what a penalty that compensates the other party might entail. And so with that, we'll turn it over to the TRG members for their thoughts on issue 2.
Questions, comments, observations? Right.
Yeah, we agree with the staff's analysis in this case that as long as the penalty in fact is substantive, which is obviously an evaluation that needs to be made, it would define the contract term. I think we would, I think it's implied by this, but I think if in fact the penalty declined to a point where it was no longer substantive, that would then define the end of the contract term in our minds.
I think we would agree with that.
Yeah, that's a good clarification. Mark?
Yeah, and I guess just to add with that, I think the discussion we had, and I don't know if you had the same discussion, but it was all around what the, when is a penalty substantive or not. Obviously, judgment. I think there were some that wanted the FASB and IASB to provide some factors to consider in that, but I know how that goes, and I don't know whether it's necessary or not. But I said the way we were sort of looking at it, and it was more if the penalty is such that a lot of people opt to take the penalty and don't actually fill out the contract, that would be sort of some indicator that maybe there's no substance to it if people are taking it. I don't know whether the staff have any views on sort of where you would draw the line. I'm certainly, we aren't supportive of saying it's a bright percent of the transaction price, and we think it would be something that you would have to look at all the qualitative and quantitative considerations in there. And but one of the big things we thought was if a lot of people are opting to take it, it seems like something's not going on there that makes it not substantive. But any thoughts you guys would have on that would be helpful.
I agree with the previous two thoughts regarding the need for the penalty to be substantive, but please do not write non-substantive penalties don't count, because then you have to write that everywhere. I think it is a general given non-substantive things do not affect accounting. Let's stop saying that, please. I do have some concern about the conclusion here. I think we can apply it, but I think this gives a lot of weight to how you choose to write the contract, because you can achieve the same economics phrasing it different. If I look at contract 1 in paragraph 46, this is written as a 4-year contract with a decreasing termination penalty. I could have written this to say it's a 1-year contract at 130 with 3 extension options at 90 each year. And I get the same economics. I assume we would not tell the company that writes its contracts that way that, oh, that's actually a 4-year contract. You got it wrong. It's not a 1-year contract with three options. It's a 4-year contract. I mean, we've looked at those kinds of things in the past, and we haven't said you must assume that the options will be exercised. So I'm concerned here that we've basically said something akin to, if the contract calls it an option, it's an option. If the contract calls it a termination fee, then it's a longer contract. We've had problems like that in the derivatives area. If you have an extension option on debt, that's an option. On the other hand, if you can pay it off early, well, no, we deal with that when it happens. So I'm a little bit concerned that this may give people an option, if they see it, to rewrite their contracts and get different accounting. I'm not sure which one would be preferable, whether I'd prefer to have it be customer options or a longer contract, but I am concerned that we can achieve the same economics with, I think, different accounting.
So that you could do that. Let's say it's a termination penalty that is borne by both parties if they terminate. So I think we already talked about that and said, well, that defines the term of the contract. So this is, I guess, a discussion of, did it have to be binding on both parties or just the customer? But you could get the exact same phenomena you describe if you don't go down view A in comparing one where the penalty is bilateral versus...
So whoever cancels pays the penalty? I suppose you could, but that's different economics.
Well, you could say it's different economics, except that the supplier may have no incentive to walk away, so slightly different, but not very different in terms of the substance of those transactions.
And Scott, in the twist on the fact pattern that you gave, wouldn't you have to consider whether there is a material right?
Oh, absolutely, yeah. So the second, third, and fourth years might well be material rights. So the entries you make in the income statement may be pretty close, but as the paper points out, we've got differences in disclosure and other things based on what you think you have.
And you could get slightly different accounting depending on how the penalty declines vis-a-vis the value of the material.
Absolutely, and timing of payment is going to give you slight differences in economics as well, but it's pretty close. So it basically says if you wrote your contract and called them options, they're options. If you wrote your contract and called it a longer contract with termination, then it's that. And maybe that's okay, because maybe we think that people write their contracts as to what they really think their business is, and we're following that. But I think you can match economics here.
Others here? Ian, over to you.
Okay, comments? Philip.
I would strongly echo the comments that Scott was making. I really liked this part of the paper until it got to the bit where it came to view A, because I'm very happy with view B. As Scott has just pointed out, you can take exactly the same contract with exactly the same payment terms and exactly the same choices to be made, and you can describe it as either an option to extend or an option to curtail. And there's no difference between the two. So to head for an answer that says those things are different when they're economically the same, I struggle to reconcile that with the conceptual framework. It seems to me the conceptual framework looks at the economic substance of rights and obligations, and this approach seems not to. So I think view A is very legal form based, and because of that it gives potentially some considerable choice to the answers that you're going to get. Mark already raised the question, what does substantive mean? And it does seem to me that it could mean two very different things, neither of which would be non-substantive. One thing it could mean is it's more than trivial. Well, a material right is more than trivial. That doesn't mean that everyone's going to exercise it. The other thing it could mean is that it's so high that it would be very unusual indeed for someone to choose to cancel. Perhaps it's highly probable that people won't cancel. Now, if we're stuck with View A, I could probably live with it if substantive meant highly probable that people wouldn't cancel, because that's a much higher threshold than a material right. But if it's really just more than trivial, then that means that we're going to be saying that.
What do you normally think that substantive means, just more than trivial?
Well, I don't think substantive has a clear meaning in this context, and that's one of the reasons why I want to raise this if we are going down View A, which I would much rather not. I guess there's a suggestion that maybe a lot of the time the accounting based on View A and the accounting based on View B wouldn't be all that different. I mean, the numbers are actually quite noticeably different in example 2. I guess I'm most concerned, and perhaps someone will tell me where I've got this wrong, in a situation where instead of this being a service, it's 4 years worth of software license. And I'm going to ignore the time value of money just for a second. But if this is a 4-year software license and you have the ability to terminate and pay a penalty at the end of each year, and we're using exactly the numbers in contract 1, then the only variability in this contract would arise from cancellation, because otherwise you're paying 400. I think that would mean that you would be required to take your revenue of roughly 400, adjusted by the time value of money up front, and then reverse revenue later on if people cancelled. And you might actually have quite a lot of experience that people do tend to cancel, and you would still be required to take the 400 up front, because paragraph 49 tells you that you have to assume that the contract won't be cancelled, and the only place you could find some variability would be by the contract being cancelled. To me, that's a really terrible answer. So I really dislike this strongly because it seems to me to be entirely form-based and contrary to the conceptual framework, and it will require people to recognise revenue that they know full well is very likely to reverse later on in some cases.
Just a short comment, because I suspect that Phil was reading the notes I did before this meeting as well. It's really that I had very much the same reaction, that I was quite happy going on from paragraph 47 and going through the analysis until I got told what the answer was. And I felt a little uncomfortable, firstly because I thought it was a very bright line and form-based answer that was coming out of the analysis. And secondly, that I didn't really think that I could entirely rule out View B. And so it seemed to me that you were going to end up with a bit of judgment in deciding where the accounting should go. And that would then take you into a position where perhaps some of the pitfalls that Phil's outlining might be avoided. The only other thing, which is a smaller point, is that on View A, on both of them, I wasn't quite sure why the contract termination in contract 1, for example, would be a contract modification, because I didn't see that there had been any change to the contractual terms.
Meaning because it was in there.
It was in
just
there
exercised a choice inside agreed terms.
Yeah.
So can I be clear with the two of you that you're not saying you want View B and not View A, you're saying it could be either depending on the circumstances, is that?
Well, I'm saying I'd like View B. I think View B is great.
So do I.
I like View B better.
Okay.
I'm not sure that I could say to someone in some circumstances that they couldn't do View A, which is why I'm not sure I would say definitely B, but I'm much, much more drawn to B than to A.
Sorry, to B.
Not that.
Sorry.
Yeah, not that we have to get in the mind of what people are thinking, but termination penalties serve different purposes. One of which is to assume continuation of the contract, which would, to me, it was probably have to be bigger numbers than here in example A, even though this is not a rules-based thing, or it's to reimburse the seller for upfront costs. Think of that you're not trying to really force them, you're just trying to get made whole. I gave you $100 a year pricing thing, assuming you'd go there, but if you cancel, you take my cell phone I sold you and go away, I expect to at least get that cost back. And that's a penalty, but it's not perhaps such a penalty that you're guaranteed to go the distance, just to reimburse me for unamortized startup costs. I don't know if we see them differently. I see those things as differently in terms of motives, even though the accounting may or not be different.
So where do you come down after all that?
Well, I don't come down firmly on view A. I think it's probably fact and circumstances is what it comes down to. But again, I think a lot of these penalties it's more so to protect, recover unreimbursed startup costs. Your unamortized cell phone or some other startup costs, as opposed to force you to go the distance. So I think it's a judgment or fact and circumstance, depending in relative severity of the penalty versus the totality of the compensation in it.
So can I just speak out of order just to respond to that? Because I am going to say some things that Phil might not like in a minute, but I just wanted to offer his answer to that point. Because I think the thing that's clever about Phil's example is that the marginal cost of providing the software in your example, Phil, is very, very small, and therefore it's difficult to work out, assuming this is some kind of consumer replicable kind of software, and that therefore it's kind of quite difficult to work out what the purpose of the termination penalty would be. And I'm going to put this up in a minute and say some things that Phil won't like, but I do think his example is a good one, and I'm not sure that, as I say, for the reason that it's quite difficult to rationalise what the or evidence what the termination penalty is really for, and to distinguish it from variable consideration. But I'm going to disagree with you in a minute.
That's why it's a fact and circumstance and relative severity against the total.
So why don't you go ahead and be disagreeable?
Well, I wanted James to have a chance first. But no, I have to say, when I look at the standard in this area, if I kind of break it down, do I think I know what to do in these examples? I think I probably did know what to do. If I compare and contrast the revenue standard with the leases standard that we will have fairly shortly, the leases standard has some additional technology that would deal with these kind of questions over contract term in a different way, and I think that's been specifically designed so that it doesn't really matter whether something's written as a termination or a extension. You always naturally finish up in the same place, I hope, in the future. That kind of technology is not in the revenue standard in the same way. I think instead what the revenue standard has is kind of a prejudice in favour of starting with the stated contract term, and then you kind of need to find a reason to move away from it. So because that's how I think the standard works, I got to view A kind of on both of these fact patterns. I can see that there are a bunch of fact patterns where that's probably kind of quite a sensible answer, because I can easily rationalise or I can find something in the pricing to convince me that I can't get to economically equivalent transactions. But there is, I think, a set of transactions for which it is going to be a much closer call, including Phil's example. And for me, the question is that a large set of transactions or a relatively small set of transactions?
Okay.
So I guess I'm in a very similar place to Brian. I thought the analysis was helpful. I think it was helpful to point us towards the enforceable rights that exist. I understand particularly the point that Scott made. I think you could maybe get to a slightly different answer depending on how you wrote the contract. I do wonder how often the accounting would be different. And I do think you would always look at, well, what is the nature of that penalty? Is that penalty substantive? And no, we don't need to define what's substantive, but is it a term that you should take into account? I understand Phil's perspective, but maybe I just, when I was looking at that situation, I would wonder whether it was really a contract cancellation. If there is a clause in the contract that allows one of the parties to do that, then I might wonder whether that is a term of the contract. And therefore, up front, in Phil's example, I would simply say, how many of my customers, a bit like exercising a return right, how many of my customers will exercise their right to terminate it early and not look at it as a sort of a cancellation through paragraph 49, just say, that's variable consideration. and therefore make an estimate of the number that would exercise the right to early terminate. And that might get me to an answer that reflects the economics and maybe doesn't lead to the concern that Phil had. So broadly comfortable with where they've got to, and I think you'd look at the nature and the substance of each termination clause.
Jane, did you change your mind?
I mean, I'm tending to find View A simpler because it sort of applies a principle that is one that I find just easier to understand as a user of accounts, that the material rights are part of the initial of the contract, and then as soon as you get into this sort of, the more there's estimation of something that might or might not happen in future, the more difficult it is. And so, most of the View Bs look, as you go through a lot of hoops to get.
Okay. James.
Ian's ready to echo a lot of what's been said.
Well, which side, though?
Going through the analysis, I thought it was helpful, but I couldn't rule out View B. And it has already been mentioned by Gary. I think it is, you've got to take into account facts and circumstances. I think there are certain contracts which would lend themselves to View A and certain contracts that will lend themselves to View B. And one needs to take into consideration why the termination clause, what it's supposed to be doing, and how the contract was constructed. It makes it certainly a lot more judgmental. I agree with Jane there. However, I think that would be the correct answer to consider.
Okay. Any further comments? I mean, it's quite interesting to try and sum this up. I think there's a feeling that maybe, by some at least, that maybe they've just been a bit too certain about coming down on View A side in all circumstances. The discussion, I think most people have said, the discussion in this section of the paper is useful and does go through the principles. But it's perhaps a bit more judgmental than the paper is conceding. And maybe if this discussion can be written up a bit, it might help clarify. I'd be interested to know whether, Jim, your side has the same sort of feeling.
So I don't think that View A was trying to say every time something is called a cancellation penalty, you automatically extend the contract. I think it comes into a point that I think Mark raised and others here is, what does substantive mean? You raised, did we have some thoughts around that? I think the staff probably does. I think at one end of the spectrum, if the contract penalty was so big and not declining, you might say that doesn't feel like material right accounting. That feels like the term of the contract is, in fact, the entire period covering the contract term. And I think that's View A. I think when you get to a point where I think that's View A anyway, and I think if you get to a point where the penalty is, borderline, you don't know it's substantive or not, or it's borderline, you start to, in my mind, feel more like, well, do you really have an analysis that feels like a material rights analysis? That is, the contract is not so binding as to make the term, instead of a 1-year contract, a 4-year contract, and now it starts to feel like, well, that is a real provision of the contract. So does that, and if you see, 60% take-up rate on termination, you go, well, maybe that isn't redefining the length of the contract. That really does feel like, well, should I get a substantive answer that differs from a material right? I don't know if you had any thoughts on Mark's question, though, and if that at least helps bring some clarity to the issue.
No, I think I agree with what you just said there. I mean, we definitely didn't have a quantitative bright line in mind, and I do think you do need to consider qualitative and quantitative factors. Some of the things you mentioned make a lot of sense to us.
I think it's also important to keep in mind what is the objective of what we're doing here with View A. I got the sense in London that there was a view that View A didn't require or permit much judgment, and I actually have a very different perspective. I think View A requires a tremendous amount of judgment. And so let's say if I enter into a contract with Allison where it's 4 years hard stop, okay, so that's no judgment. The duration of the contract is 4 years. But if it's 1 year with some way, shape, or form to get to 4 years, then we're in the camp of having to apply judgment even under View A. And so the objective of this is to determine what is the duration of the contract that I'm going to account for. Once you determine what the duration is, then you assume that there'll be no cancellations and the contract will come to fruition through whatever that duration is. And you're trying to make a judgment call on what are the enforceable rights and obligations. And so for me, a significant penalty isn't so much a question about is it really significant to this individual entity or not? Is it so significant that the customer or the entity would have to disclose it? It's about, does the fact that there's a penalty actually show you that really the term of the contract or the duration of the contract that Allison and I have is 4 years? And to Jim's point, if the ultimate judgment you make is that the duration of the contract is something less than the maximum, then you'd be considering whether there's a material right. You may conclude there's not, but you'd at least have to consider whether there is that material right element to the contract.
Larry?
So can I just try to clarify what you said, Jim? Because what I think I heard you saying was the hurdle for substantive right is fairly high, is higher than a material right. That's what I heard you say, because what you said was that the penalty has to be so substantive so that it effectively defines the length of the contract, whereas you don't need to have something be as certain in order to qualify as a material right. Do I understand what you're saying?
Yeah, I wasn't maybe trying to say it that it's all the way at the ceiling, but in my view, if you're going to redefine the term of the contract, so it says it's cancelable. So it talks about, if you have a cancelable contract sort of at will, then it's the shorter term. If you're going to say it really becomes that longer term, is that provision in effect making that otherwise 1 year contract a 4 year contract? I wasn't trying to say where that is, but do you effectively have the longer term of this contract?
Okay, so then effectively what you're saying is it's not always View A and it's not always View B. It's a facts and circumstances consideration to determine which view you think is most appropriate in the circumstance.
Yeah, and I think I could see the confusion. I think we're going to need to work on this and how we write it up. I thought Cullen described it well, which doesn't necessarily come across in the paper. I think one reading of the paper is, well, if you have one, it always extends the term, and it doesn't get into, well, what if it doesn't extend the term to a longer term? What is that provision? Is it something that should be ignored? Is it something that could result in material rights accounting? And I think part of the reason this was raised, because we've already talked about this issue at the TRG, and in that context it was, let's just say it's the cell phone, you pay nothing up front, but if you cancel, there is a penalty that is incurred by either party. Now, I don't know why the supplier would cancel, but it seemed that the discussion around the table was if you have a cancellation penalty that's binding on both parties, that defines the term of the contract. And people said, well, what if it's only a cancellation penalty incurred by the customer? Should you get different accounting? And I think this was trying to say you don't get different accounting just because the supplier doesn't have to pay a penalty. But I think we've now got some of the subtlety that we could capture in the discussion as well.
Okay. Philip.
I was very confused when Cullen spoke because I don't know what you're trying to say to use judgment for. I look at contract 1. My assumption in reading this is that we're supposed to assume that some terminate and some don't. Does that mean it's 4 years, or is it less than 4 years because some do terminate? I didn't think there was judgment here other than obviously you're not going to think about a non-substantive termination penalty doing things. But it sounded like, Cullen, from what you were saying, you would need to evaluate whether you thought lots of people would terminate or nobody would terminate.
No, to me the judgment is the mere fact that there's a clause that says there's a termination penalty doesn't automatically kick you to the 4 years. You have to assess how substantive that is. And to me, that will require judgment. One thing you might look at, which I think was Mark Crowley's point, one thing a company might look at in making that judgment as to whether or not it's significant is, do customers typically say, we don't care, we'll pay the penalty and move on, or not? And if that happens frequently or rarely happens, that might inform an entity's judgment.
But it's only in evaluating whether the penalty is substantive or not. Having concluded it's substantive, you go the distance.
Yes, and if you conclude that it's not substantive, then you'd be in a situation of having to make another judgment about whether there's a material right. Jim?
I think I agree with Larry in that if this seems to me very similar to what do you do with a lease, and when do you include optional terms, and the threshold's pretty high for when you do that. And now there are qualitative factors that would enter into that. So, in this particular case, is there an alternative supplier? That would be one factor, or is there some other metrics around how often parts, are worn out and you have to replace them and things like that. But I definitely think that the threshold for, if you want to call it extending the term or concluding that there's some minimum parts, is a pretty high threshold that's higher than a material right.
Yeah, I agree with that. I don't think we're trying to define it, in a specific threshold, other than it's a relatively high bar.
I think
Jim, we've got another comment here, if we can.
I just quickly. I think the tension here is you say in the fact pattern that the penalty is substantive, and I think a lot of folks are focused on $20 compared to $100. People can truly opt out here. So I almost think that if it's substantive, you're view A. If it's not substantive, I think you're some form of view B is where I get to.
Yeah, I think that's right. And I think the example probably shows a penalty that some people would say, are you really sure that that's substantive? And it's probably an example we don't want to keep in terms of people's thinking about this. Ian?
I'm not going, Phil. You can go now.
No, actually what you just said is exactly what I was going to say. I'm very happy with the direction of this discussion in terms of what substantive means. I think if you then come back to these two examples with that in mind, you start to have serious concerns about whether these examples really include substantive penalties. They look pretty small.
Yeah. Okay, good. Thanks for that. That's it here, Jim. We can go on to issue 3.
Jim, how's this going to be summarized?
Yeah, great. Yes, very carefully.
All right. Hopefully there's a little bit more substance in the summary related to this discussion than we normally have.
But I think we just had broad agreement that the tension point was the number in the examples. At one point Mark and Phil were on what appeared to be two different views, but they came around to the nature of, when it's focused on substance, they question whether or not the facts in question in Contract 1 actually with a $20 termination penalty. And what I heard was there's broad agreement, but Nick needs to make it $50 rather than $20.
Part of it might be in the way you asked the question, too, because if you say, is a cancellation provision always an extension of the term of the contract versus how do you evaluate the impact of cancellation rights, which then leads to not such a binary outcome of saying it's always this or that, but how do you evaluate them?
See, I wouldn't agree to changing the number in example 1 to 50. I'd rather you say that under contract 1 you would come to view B, under contract 2 you might come to view A.
Look, I don't disagree with either of your points. I think we have to be very careful on examples that are right on the line of saying it's this or that versus here is the framework to evaluate cancellation provision.
I think to say under contract 1, you're coming to view B, you are having to come to the conclusion that these penalties are not substantive. And I'm not sure we can tell that because it says assume they are.
Scott?
I think that gets back to a point Phil brought up. When we say substantive termination penalty, do we mean such that virtually nobody ever chooses to pay it, which is a very high hurdle to be substantive, or do we mean, such that it's enough that people would care and would factor it into their decision, right? If the termination penalty was, 1 yen, then probably everybody would say not substantive because you're not even going to think about it. But if a termination penalty is, 100 euros, then most individuals would at least think about it, but would it be large enough to make nobody ever choose to pay it, and which hurdle do we care about? One other point I didn't get a chance to make, the descriptions of UA, as was pointed out, say that it's a contract modification if the customer chooses to cancel. I wouldn't be quite so strong as that because it might be breakage. If you have a service contract that is technically 4 years, but you have evidence that most stop after 3 years, wouldn't the breakage guidance apply?
I think just from a staff perspective, I think that's somewhat fair. This goes back a little bit to the issue we had. What was it? It was 1 or 2 meetings ago where there was almost there were 2 acceptable views for accounting for a customer option to buy additional stuff. I guess to some extent it would be probably more consistent with what the TRG concluded there to also conclude that similarly there's probably you could look at an option to terminate the same way, meaning it would be either not, it was built into the contract, was view A in that paper a few months ago, and view B was account for it like a contract termination. The TRG concluded that either would be a reasonable application of the guidance. I would personally, this is just, we haven't talked about this a lot, I would find it difficult to come to a different conclusion about a termination option. So I probably wouldn't view the description of view A as necessarily hard and fast that that's what we do, but it would also might be hard to say that's unacceptable.
Sure, I understand.
It sounds like, to me, the staff has enough to capture this discussion, and if we're going to try and get into when do options become forwards, we could start going about the accounting for material rights as well, and say, well, when is a material right so deep in the money that it effectively isn't a material right anymore? It redefines the contract, and we haven't had that discussion. I don't think we need to. I think we can capture the essence of this in the minutes.
Issue 3. So the third issue in paper 48 arises in contracts where really a customer might be economically compelled to purchase optional goods or services, but the contract does not have a penalty that compensates the other party upon termination or failure to exercise the option. So this issue often arises when there's initial purchase of a good or service at a loss, or maybe even a significant discount with the expectation that the customer is going to continue to purchase more profitable items in the future. So if the goods or services underlying the options are considered a part of the contract, a portion of that transaction price associated with those future purchases would be allocated to that initial purchase and, improve the margins on those transactions. So the paper describes 2 primary views on the accounting for the options in these situations. And the first view is really, well, if it's a contractual option, there's nothing that would tell you that you have a longer term through a penalty that compensates the other party. You only account for it if there's a material right. And view B is you try to evaluate whether there's some sort of significant penalty, maybe even outside of the contract, that might economically compel the customer to purchase additional items. And there you'd have effectively a de facto minimum based on that economic compulsion. So staff ultimately agreed with view A because we think it's really just probably more consistent with the model provided by the boards, and the new standard actually doesn't require the estimate of doesn't require you to estimate future purchases by the customer. So I guess with that being said, as described in paragraph 67, we do still think there are, as noted in the last discussion, significant judgments thinking through and determining the extent of the legally enforceable contract. So we do think it is important for stakeholders, and they're going to have to apply judgments there, and also consider that the guidance on contract combination.
Subsequent to the paper, I know some have raised a question, not necessarily about the revenue side of the accounting, but in situations where there's otherwise what somebody might describe as a loss leader, particularly in the context of a longer-term contract. Are there implications on the cost accounting side? That is, when, if ever, do you have, say, an intangible or an investment in the contract, or whether or not somehow the revenue recognition standard changed cost accounting? If that's an issue that the TRG thinks is important for us to take up in terms of the revenue accounting standards change on cost accounting or investment in contract type thinking, might be useful for a future discussion if we had a write-up or an analysis. But this was sort of intended to focus on the revenue side of the transactions. Brett?
I think we tend to agree with the staff's analysis here. I think the standard does refer to the notion about legally enforceable. I think it contrasts it with performance obligations on the vendor side, where you might look at vendor expectations. Like loyalty programs, for example, are not legally enforceable. But in terms of the customer's obligations, I think the notion in the standard does seem to suggest it has to be enforceable as a matter of law. And so I think the way the staff have analyzed it is right. I think it's operational. I do think it will, in some situations, result in outcomes that might be disconnected from the economics. I think the loss leader examples that you're referring to, I think part of that. And I think the challenge that we see, we've been hearing about is sort of the contrast between what we think the accounting would be if in fact I've delivered a performance obligation to the customer at less than my cost and have to record the expense through the P&L because that's how the model works. The standard suggests that you can't defer fulfillment costs after you've already fulfilled. So if I've delivered the performance obligation to the customer, I've recorded my loss. Contrast that with a scenario where I pay cash to my customer. At least seems to be a view that says, well, in certain scenarios that would be potentially an asset. So I think it puts pressure on those fact patterns in terms of sort of being somewhat disconnected from the economics. But I do think that's how the standard is worded.
Yeah, I think we like the staff's analysis in part because we think that makes it operational. We think that the other view is almost kind of like a reverse material right. Like I am in the entity and I can give customers material rights, but somehow if I sell them something at a loss, they are giving me a material right. I guess I think that that's an interesting economic accounting question, but I think you'd be biting off a lot to chew and differentiating, because I think back to growing up, my mom loved a certain type of ice cream from a particular dairy, and so she would scan the paper every Saturday to find where it was on sale. The stores might run that ice cream as a loss leader in the hopes of engendering customer loyalty, but my mom, she was a cold-blooded killer. She was not going to be loyal. She was only going to buy the loss leaders, and we would drive all over town buying loss leaders at every store. So I think I hear, to me it's loss leaders are like a business strategy. They're like advertising, they're R&D. It's a business strategy. I don't think we should confuse strategy with accounting.
It's not like she had brand loyalty, not store loyalty.
That's true.
I'm seeing how Brian wound up as an auditor for his career, but I also agree with the staff paper here. We've had plenty of problems under the current literature in the U.S. where sometimes we treat things that aren't legally enforceable as nonetheless being part of the contract because we know it's going to happen. And when we start trying to play around with that to figure out where the line is, I think it's awfully difficult. We wind up with guidance like contingent deliverables guidance that helped resolve some problems and created just as many. So I think that this is the right way to go. To Brett's point about sometimes maybe if you pay cash to a customer, you might think you can record that as an asset. I always thought that was only the case if you actually got a contract back. But yeah, maybe there is something to talk about in terms of customer relationship assets. But I agree with Jim. That's a different issue. This is looking at the revenue side. I think this is the right analysis. Clearly,
Russell.
Yeah, I guess unfortunately, we have a lot of experience with the loss leaders. We sell the aircraft engines and hope to make up the losses on engines through the parts. So we've given a lot of thought to this question over the years. I agree, actually. I think the economic compulsion notion is a very slippery slope. I think there's a number, even within GE, there are a lot of transactions where you could say there's economic compulsion that are almost virtually certain that you're going to get an aftermarket or a revenue stream to follow. So on your point on the question of a customer intangible, we've given a lot of thought to that question too, because we've got competitors applying IFRS that are deferring losses on these engine sales, and so we've thought about how you would get there under U.S. GAAP and really struggle with the idea. The best we could do really was some kind of purchase of a customer intangible, but as we started to think about the implications of that just within GE, we thought we would be opening up a lot of questions about, all right, well, what about other loss leaders, and why would it be different, and why wouldn't you say you've got a customer intangible for a lot of things? So without a business combination, how do you really justify under GAAP recording these intangibles? So we've shied away from it for that reason. We don't think it really is affected by the new revenue standard. It's a separate question. But I think from our perspective, we kind of looked at it and said, well, two things. One, investors really were pushing back on that accounting in the industry. And so we said, well, why is that? We started to appreciate that the ability to defer these losses or capitalize them, you lose, as an investor, I guess you lose visibility into the cost execution. And from an operational perspective, you lose that as an incentive. What's the incentive to take costs out of a manufacturing process when you're always able to capitalize it and defer it over a 20, 30-year period? So for a lot of different reasons, we've said, not the least of which is that we can't really find a basis in GAAP. We've shied away from that approach.
Yeah, I won't add much, but I think, Jim, your question was, do we think this is something that we would support? I would support certainly looking into the cost side of this and whether or not the losses can be capitalized. As far as pulling forward revenue, I think the way this has been analyzed is the right way under the standard, and I didn't see any basis for pulling forward revenue. Now, if we want to talk about the actual cost and whether or not those should be capitalized and deferred, I think that's probably a separate project. But I remember sitting in here at one point when this revenue was being discussed, and loss leaders was very clear that you would not pull forward revenue for loss leaders, and I thought that the FASB made that clear.
Other questions, comments? Ian, over to you.
Thank you. Jane.
I'm glad somebody's mentioned investor pushback and potential for hiding what's going on, because sometimes in these conversations it's difficult to remember exactly what the new RevRec standard is for in the first place. And so I found this part easiest to agree with and understand. The basis for conclusion statement that we don't want estimates of consideration from future exercise of options for additional goods or services. Now, what might be the motivation for a preparer to want to have those sorts of estimates of future sales? Well, it's because there's some sort of problem with the first tranche of sales, which we certainly don't, exactly as Russell's described, we certainly don't want to be hidden. Yeah, it would seem that if there's a loss leader exercise going on, that should be transparent, and it's absolutely fine. Somebody said it's a business strategy, but let's make sure we can see it's a business strategy. And a fundamental point of this standard is that it doesn't allow sales. There's much less scope for pulling forward sales than there was with the old standard.
Thank you, Philip.
Yeah, I was happy with the discussion of issue 3. I guess the only thing I would say is that when we're talking about loss leader scenarios, but merely by calling them loss leader scenarios, you're kind of moving yourself towards issue 3 anyway. But if you think of that more broadly about the scenario in which you may provide something up front, and to some extent you are going to recover that through the amounts you are charging on an ongoing basis, then we shouldn't lose sight of the fact that issue 1 and issue 3 are actually very, very close together. The discussion we had earlier on issue 1 and the judgment, that's still going to be really important in some of these scenarios. If you've applied that judgment in issue 1 and concluded that these are additional goods or services, then you're in issue 3, then you've got a clear answer. But you've got to go through that analysis in issue 1 first, I think.
Okay. Further comments? Mary?
One thing that struck me, I think on this third question, it's pretty straightforward ratification of guidance that's in the standard to begin with, and the staff has flagged that at the beginning of the issue. Sorry, I'm just looking for the reference when they say standard says you don't anticipate the probability of exercise of options. I think it's very useful to have had this discussion in light of the discussion we just had about issue 2 in the cancellations, because I think if you take the two discussions together, it's that the revenue accounting is based on the enforceable contract, that you are not factoring in exercises of options on a probabilistic or expected value basis, and that's a clear affirmation of what is in the standard already. I think some of the concern, hesitancy, et cetera, that we heard expressed in the discussion of the previous issue about cancellation rights and some of the assessments of them, combined with statements that are made about cancellations can be seen as the equivalent of options, may have kicked up some dust on that. But I think Colum's commentary at the end of the debate on the second one just ratified the basics of you're looking at the legally enforceable contract. You're not anticipating other events on a probabilistic basis. Yes, you do have to consider whether the existence of a cancellation right raises a question about what the legally enforceable contract is, but you're not doing this. This third issue emphasizes that you're not doing it on a probabilistic basis, and hence you don't get to things like economic compulsion. So I think it's helpful to have looked at these as a package and reminding ourselves what the anchors are in the standard today.
Okay. Brian.
So I certainly agree with everything Mary said. I just had one very small clarification point. I certainly agree with view A in these fact patterns. My only concern, and perhaps it's only drafting, is that view A says you look at what's legally enforceable, view B says you use judgment, which feels like slightly unfortunate antithesis. I quite liked the articulation at the beginning of paragraph 7 that the threshold is that you're looking at what's legally enforceable, but sometimes judgment may be required to assess what is and isn't legally enforceable.
Okay, thank you.
So, could I just tack on another kind of drafting point? I think it's implicit, but if you look at paragraph 65, staff view does not think that the standard requires estimating future contract. I think it also does not permit it.
And I think just fair point, Mary. I mean, this because I think in the mind of partly in the mind of how this has been developed, it was because of concern that you had to do it. So it was in the thinking to say we're trying to provide the reassurance that you don't have to do it.
Philippe.
Just a small question about the notion of legally enforceable. It might not be in the contract, but there might be a regulation out there which requires that the parts for the maintenance of an engine sold by GE or whoever, CFM, must be OEM parts. There is no way you can buy any parts outside of the OEM. There's regulation, aircraft, maybe air safety regulations. It's not in the contract. And you are sure that to keep the engine going, the customer will have to buy a number of parts at various times for the maintenance. Isn't it a situation where some could think that the regulation creates an unenforceable right, although it is not in the contract itself, but it's obvious that the only way the customer can benefit continuously from the product he bought is by buying parts from the original supplier. So is there something to clarify here?
But staff can clarify here as well. I think we thought unless it's an obligation on the part of the purchaser that they buy the future parts, it's not an enforceable right. They're not obligated to use that engine. In fact, if they sell the engine, it's not even the same customer that might be buying the parts. So you'd be, you can make the same argument with a printer where the cartridge only works, or the printer only works with a cartridge from the OEM, and then say, well, I'll have to estimate how long I think they'll use this thing, and are all of the future purchases included in the contract. And I think the framework, and I think Mary said it well, is clear, is you don't pull forward optional purchases, so things that might occur in the future unless they're contractually required.
I'm making the point only because I think some people might be hard to convince. Because clearly for the customer who has invested a lot of money in this aircraft engine, he needs to have continuous benefits from using the engine, and he needs to buy parts. And you know it's going to happen, for sure. You may not know exactly how much, but you know based on the fleet of number of engines out there, how many parts you are going to sell for the maintenance. So I believe some people will need a bit more flesh about the discussion, maybe to be convinced.
Well, we can think about how we write up in the minutes, Philippe, but I think it's all of those facts and circumstances that cause some people perhaps to raise a question, and also saying, well, isn't there economic compulsion for those contracts? But I think, as Jim and Mary have just said, I think it comes back to saying, do you actually have those enforceable rights and obligations? I mean, all of those facts and circumstances might lead you to reach stronger conclusions about whether or not you have some sort of strong relationship with that customer, because there's a flow of possible future contracts, and they're very likely to occur, and if they do occur, they're going to have to come to you and not go elsewhere. But I don't think they create rights and obligations in the contract.
In the business combination, as I think a colleague from G said, in the business combination, you will recognize those rights as an asset.
Yeah.
So I think we're a bit inconsistent here somewhere.
Well, no, I think it's I would say perhaps it's a question of thinking about what assets you'd actually be recognizing and whether it's contractual.
Yeah, you could conclude. I think we need to have this kind of analysis to have a complete picture, and then come to the conclusion, in a business combination, this right is an intangible asset. It's not a contractual right per se.
Tony.
I'm comfortable with where the paper gets to. I think the standard does require that you consider rights that are legally enforceable. I think it is important to remember, as Brian said, that there may be judgment required to decide what is legally enforceable. I think there might be circumstances in which something that is not written in the contract could be legally enforceable. But I'm looking at it very much the way I think Henry just described it, that there might be something that's it's not the operation of law or whatever. There is a promise that I might have made verbally or through an implied practice that would be enforceable in law. And I think in those circumstances that then maybe I would take it into account. But the important thing is that it is legally enforceable. I do think this will perhaps in some circumstances put tension on the accounting for the asset. I do think you could end up in some circumstances with slightly different accounting for a cash payment to a customer. But in the context of the issue that's been teed up here, I think the staff has got to the right place, and I support the answer.
Tony, I think your point, we tried to, the staff tried to make clear in paragraph 67 about making sure you're identifying the contract so that if the enforceable contract differs from the written contract, that of course is a matter of law and judgment.
Yep. Agreed.
Can I just, as I say, I'm happy with where we've got to on view 3. I think given the discussion we've just had, though, it might be helpful just to contrast view 3 with paragraph 28 on view 1 and the example, VC example 1 there. Because in view 3, I think it is really important to the analysis that we're looking at options for additional goods and services. The fact that there are additional goods and services is a critical part of the analysis, and therefore we're saying you don't take them into account. If we go back to issue 1 and VC example 1 under para 28, there we're supplying an engine or something, maybe it's not an engine, maybe it's some other bit of equipment, for payment that will be driven by usage, and there is no minimum level of usage. And we're saying, yes, you would estimate that. You would treat that as variable consideration, even though, of course, there is no obligation to use the engine. So we're getting to a very different place there because it's not additional goods and services. And I think that's a very important and subtle distinction that people need to keep in mind when they're thinking about this topic.
Okay. All right, Jim, have you got anything further on our first issue?
I don't think so. I think, I think to summarize, there was, and again, if I'm not capturing this right, let me know. But I think on the first issue, there was a general agreement with the thought process laid out in the paper in terms of distinguishing between an optional purchase and variable consideration. So the factors that you might consider in thinking through that, and the fact that judgment will, in some fact patterns, be required. The second issue captured through the discussion is perhaps it's not as binary as illustrated in the paper in terms of the thought process. And so walking through when is a termination provision, define the bounds of the contract versus at the other end of the spectrum, it's, can it become more view B like an optional purchase? That is, it doesn't redefine the bounds. And I think we'll try and thread that needle in indicating that there will be judgment in those fact patterns as well, but that if a termination provision is, at the highest level, you walk away, there's no flexible ability to walk away. I think no disagreement that ought to be the boundary of the contract. Again, we'll circulate these. You'll give us your comments if we haven't captured it. The third issue, I think I heard relatively unanimous agreement with the thinking laid out in the paper, with some suggestions including clarifying the optional purchases vis-a-vis even if a purchase might be required under law in terms of a replacement part if you choose to make it, that we're really looking at the required purchases within the scope of the contracts and not pulling forward future sales. Have I captured that at least reasonably well? Hearing nothing, I'll either assume no, and you'll tell me offline, or we'll get it in the minutes process. To you, Ian, on the next issue.
Yeah. So issue 2, which is agenda item 46. Mary, you're going to tee this up.
Right, thanks, Ian.
Not you.
Thank you.
Missed that detail.
Memo number 46 includes 3 questions on accounting for pre-production activities. Question 1 relates to identifying promised goods or services and is applicable to both GAAP and IFRS. Questions 2 and 3 relate to U.S. GAAP guidance only. I'm going to tee up question 1 for discussion, and then after we conclude the discussion of question 1, we'll move on to questions 2 and 3. So on question 1, some long-term supply arrangements require an entity to undertake efforts in an upfront engineering and design to create new technology or adapt existing technology to the needs of the customer. The pre-production activity is often a prerequisite to delivering any units under the production contract. Stakeholders have raised questions on how to determine when pre-production activities are a promised good or service in a contract with the customer. This question is somewhat linked to the discussion from January's TRG meeting, where we discussed the identification of promised goods or services. In that meeting, there was discussion around the guidance in the standard that states that promised goods or services do not include activities that an entity must undertake to fulfill a contract unless those activities transfer a good or service to the customer. The staff's analysis in Memo 46 transfers on transfer of control as a key consideration in determining if the pre-production activities are a promised good or service. That is, if control or the good or service transfers to the customer, then it's likely a promised good or service for purposes of applying Step 2 of the revenue model of identifying performance obligations. Furthermore, this notion is also applicable to determining if pre-production activity should be included in measuring satisfaction of a performance obligation transferred over time. So with that, I'll open it up for discussion by the TRG members in London.
Okay. Any comments here? Phil?
There wasn't anything in this first part that I disagreed with. I think it is focusing on the right sorts of questions. But I do think that this is a particularly difficult aspect of dealing with the standard. And I'm not sure that we've yet got to a place where we're going to see as much consistency of application as we might like. I think there are probably questions that will still be very difficult to answer based on this. Paragraph 9, I think, is helpful in thinking about whether control of a good or service is ever transferred to a customer. I think in that situation there might be 3 possibilities. One possibility is yes, it does transfer, in which case, yes, it's likely to be part of the activity. If actually at the end of this contract there is still an asset and you're still using it as a seller and therefore control clearly hasn't transferred, I think that strongly suggests that it isn't part of the performance obligation, not part of the activity. Of course, the difficulty is that in many cases it's neither of those two. In many cases it simply doesn't exist anymore by the time you get to the end of the contract, and there I'm not sure that this is particularly going to help one way or the other. Certainly there are a lot of industries where mobilisation activities are very significant at the start of a contract, and I believe that there is some diversity in practice at the moment. And I'm not sure that this is going to eliminate that diversity. So I don't disagree with anything, I just think this is a big topic, and I'm not sure that we've given all the help we could possibly give yet.
Do you think, on that question, I think it's really possible to start giving more help that's going to be useful generally? You can go down to individual cases all the time. But
Not necessarily. I don't know whether it's worth trying to have further discussion about it to see if there are things that can come out. The paper we just finished discussing is equally difficult, and yes, I think some useful thoughts came out of that. So I think it might be possible to do more.
Any other? James?
Ian, to echo a lot of the sentiments that Phil gave, in my outreach around this one, there seems to be a fixation very often on legal title, but when you look at the contract, it's not necessarily, the legal title seems to be more protective than anything else, and you've got to look at a lot more than just what the facts would indicate on the surface of it in the contract. I thought as well, to me, paragraph 9 was the most helpful in this section. And I think it sets out the way to think about it. I didn't think we needed to go more in depth in this particular issue, but I'll leave that to the staff to decide.
Okay.
Yeah, much the same. I thought that this aspect of the paper was helpful. There are not going to be straightforward answers to some questions, but I think this gives you the framework for the things that you might want to think about. So, is control of this asset ever going to transfer? And if it is, then how am I going to apply the revenue standard? If not, then is it going to fall into the one of the other asset standards, or would I look at it as a fulfilment cost? Would I even look at it as a lease? But I think what the paper does is point out, to my mind, that there is enough in the standard, and I don't think that this group could ever hope to answer all of the detailed questions. So I think I'd be inclined to say it tells us what the framework is, and let's work with the standard.
Jake.
Thanks, Ian. Similar to what others have said, I think that what's laid out here clearly articulates the principle, which is are these fulfilment costs transferring a good or service to a customer? But I do think there are going to be areas where judgment is required, and I think that the examples that you give, Phil, in point those types of arrangements where actually those fulfilment costs may have no value at the end of the term of an arrangement because they've been used up during that contract, are likely to be those ones which are particularly difficult.
Okay. Now, that's the discussion on the first point. The next 2 points are US GAAP questions only. So I'll kind of take comments on them on an exception basis if people feel. Otherwise, we'll leave it to our colleagues on the other side. Okay, Jim.
Discussion here on issue 1. Alan.
Sorry, I would just echo some of the comments internationally that were mentioned, that I do think there probably will be some diversity. The write-up actually mentions or sort of implies this by saying that if there's current IFRS or US GAAP, that an entity will apply that prior guidance. So I do think different companies will have differences in applying this guidance. And so that's something you should just be aware of in this write-up in accounting.
Yeah, just to clarify, that piece is really on question 2, on looking to existing GAAP. So on question 1, really, it is just looking to 606. The question on the existing GAAP is more on the cost capitalization side.
Alison?
So I think we agree with the staff's point that I think paragraph 9 says that it's helpful to think about whether control is transferred. I think we believe that that's required part of the analysis. But where we're finding there will likely be diversity in practice is around that assessment of whether control of something transfers or not. And what we're observing is that oftentimes, just generally speaking, looking at transfer of control, people look at the control indicators and focus quite heavily on legal title, and whether legal title has transferred or not. The standard is clear that none of the factors individually are determinative, that it is a matter of judgment, but I do think that there's perhaps sometimes a bias that legal title becomes sort of the presumptive or the overriding indicator in a lot of instances. And I think that questions around customer-owned tooling, when legal title may technically transfer, sometimes that tends to lead the debate towards inferring that it should be a performance obligation when there may be other facts and circumstances that should be considered. We're also seeing other situations where legal title may not transfer, but a company is asserting that they actually that they should be accounting for something based on the transfer of the promise to the entity, even if legal title doesn't transfer for legal or regulatory reasons in certain jurisdictions. So I guess my point being that this discussion around transfer of control and the role that legal title plays in that analysis, we're finding to be an area of difficulty and will likely arise or result in diversity in practice, I think.
So it's a broader, it comes up more specifically in the pre-production cost, but a broader application of the control and when it's
Yes, and we have, again, taken the view that we think that it is just, transfer of legal title is just an indicator and that it isn't presumptive. And I think it would be helpful if there's TRG members or board members that would think otherwise. It would certainly be helpful for that to come out as part of the discussion. But otherwise, our thought is legal title should be evaluated with all of the other indicators of transfer of control. And there may be facts and circumstances that would indicate that just because legal title has or hasn't transferred, you may come to a different conclusion with regards to whether control is actually transferred for a good or service.
Brett?
I think the struggle that we're having sort of is the what appears to be a conflict in terms of existing U.S. GAAP in this 340.10 area, specifically the piece that talks about, that Allison referenced about capitalizing the costs that I've incurred to build a tool that you own, it's titled to you, which seems to suggest that I'm accounting for it still as if it's my asset. Yet I've got the first analysis in this paper tells me I have to evaluate whether in fact try to transfer something to the customer, which might suggest that it's a part of my performance obligations in some cases. So it seems like it's hard to make those two things coexist, where I can both treat it as a performance obligation, record the revenue, and then capitalize the cost for tooling that, not my tooling, but someone else owns. So, I could read that to say, well, in those situations, what I'm telling you is ignore the revenue standard, because since you're using the tooling under the customer's discretion, as long as you're producing the parts, then it's your tooling. In effect, as I could read it that way, but it just seems hard to make those two bits sort of work together. And while the other elements of 340.10 that relate to sort of setting the bar for when you capitalize costs of your own tooling, which is more like PP&E, and that's probably pretty obvious, but NRE, the non-recurring engineering costs that might otherwise be expensed, the standard, that guidance that comes out of the old EITF provides you a framework to set up an asset that arguably is a higher bar than in the revenue standard, and that's fine. I mean, that you can sort of see how those can work together, but it just seems like it's just really hard to put the pieces together when I've got one piece of GAAP telling me that I have to capitalize these costs in certain scenarios, even though they relate to tooling owned by somebody else. And then another piece of GAAP telling me to go ahead and treat that as a performance obligation. So it seems like we need to resolve that conflict one way or another.
Brett, just a question. So when in your comment, you said a couple of times, the tooling owned by somebody else, and I think it links well back to Allison's point on they have the legal title, but you have to think about under 606 whether control of that actually transfers and whether you determine, if control has transferred despite if there's legal title, that might influence how you do that accounting. There's not necessarily a presumption that because legal title has transferred that control has transferred.
But we can try and capture that here. I think part of your point might be we had a guidance that was written in an era that was pre-control, and did we update the cost guidance to make clear that we were not necessarily talking about transfer of title anymore? We're talking about control. I think we can try. Mary, we can try and do that in the minutes process. I guess you could ask whether that's like a technical amendment or something like that.
It just seems in certain scenarios it seems like I have transferred control, even though I still am using it. Title does sit with the OEM, let's say, and it might be a short-term supply arrangement where their every intention is to pick it up when the project's done and reuse it. It may be protective. It may be some other reasons why they're doing it, but I think the notion about transferring control, in fact, title has transferred, and so in certain scenarios, it just seems like there's a direct conflict there.
Russell?
So I thought the paper was helpful. One of the things that we were struggling with, we had a lot of discussions about NRE and pre-production type costs. One of the things we were struggling with is how do you think about an arrangement where you're designing a customized piece of equipment and you're going to deliver a number of units and it's highly customized, but yet the technical specifications or the specific design deliverable doesn't really transfer, and how to think about whether you should be recognizing revenue during the pre-production NRE period. And so I thought the paper was helpful from that perspective to think about, well, does the technical specs, does the design activities, does it really producing something that's going to be delivered other than the units themselves? So from my perspective, I thought that was helpful. It's interesting, though, because sometimes that design activity could be the very thing that's causing this arrangement to be accounted for as a single performance obligation, and to not think about that activity as being something that's transferring control over time if it's being accounted for as a single performance obligation is a little bit strange, but I think I get it. At least it's helpful to kind of move us in one direction or the other. On the other point about the inconsistencies with the tooling and title transfer, did we think about taking 34010 out of? Did we think about maybe eliminating 34010 altogether, because it is an inconsistent piece of literature. I know this isn't cost guidance, but we did eliminate a lot of other cost guidance in 81.1. So why did we leave 34010 in? Just a question.
Personally, I think that's a fair point. It seemed like at the time of the revenue project, the board was not focused on making improvements on the cost side, merely focusing on the revenue side. But they were aware of the fact that through some of the changes made in the revenue standard, there would be some gaps in cost accounting. And so 34040 fills the hole. But I agree with you. I can see someone looking at 10 and then looking at 40 and saying, well, why?
There are a lot of inconsistencies in the two. The thresholds are different,
yes.
and I think that's what's creating most of the confusion.
Brian? I guess one observation, Russ and folks, on that point, we just had a discussion a while ago about master supply agreements with optional purchases, and we conclude, well, each purchase order would be the contract, right? And so I think that contract that we've now been very, kind of precise in GAAP and applying the principles in this revenue standard about what the boundaries of the contract are, which might be, build these parts that I need for the next 2 weeks. So if you think in those terms, then this 34010 with its notion of undefined notion of long-term supply agreement, it's not long-term supply agreement under the revenue standard. So I guess to your point, I almost wonder whether 34010 is in essence in many fact patterns been orphaned, in that it's not look at from a revenue standard with the rigor of the revenue standard, it's not a long-term supply agreement. It's a purchase order for the next 2 weeks, and that's it. So I guess I'm wondering whether, look at it from that perspective, whether that might be helpful to some people.
Yeah, I'm not going to. I agree that this is going to be judgment, and it's going to require. I think you've laid out some factors here that if the good ever does transfer, then it's going to be performance obligation, and if you're doing non-recurring engineering, that you give enough, I guess, reports or progress that they don't have to necessarily reperform all what's going on. That'll be a performance obligation, and everything else is sort of going to fall out is not. I think in the paper that was submitted, and someone had sent it to me, that they did also talk about the reimbursements that you get for this, and whether or not those should be shown as offsets to some of these costs that aren't performance obligations or not. And I assume what this is saying is that if they're performance obligations, then this is clearly revenue. But if it's not a performance obligation, are we suggesting that reimbursements for that could still be offsets or not? I think today some people believe some of those reimbursements are not in the scope of 605, but now they're part of a contract with the customer. So I just wonder what the staff's view is on the reimbursements for these, and why that wasn't addressed in this paper.
So the submission was focused on whether the pre-production is a performance obligation or just a cost under 34010. We didn't have the submission didn't include a question on the payments, but I think on your first point, if you determine that it is a promised good or service, that payment would be related to revenue, and you'd have to figure out, you allocate and treat it as part of the transaction price. If it's not, I think you'd have to look at, what does that payment relate to? Some things to think about might be kind of linking back to the first question. Is your contract for pre-production and units, or pre-production with the material right for the units. You might think about that differently than if you have a contract just for the pre-production. So I don't think there's a black and white answer, but I think you have to look at what that payment relates to and make a determination how you treat it. But it wouldn't be part of the transaction price if it's just pre-production.
One of the things, I mean, if there's a practice out there of making payments to your supplier, but the supplier not recognizing those as revenue today, sort of the basis for that would be useful to understand. So you're buying goods or services and you're getting cash for that, but you're recording it as an offset of your costs. Just a little bit of the basis today of how people get there would help understand, maybe whether or not the new standard changes that.
My understanding is the basis is that it's not revenue. It's not in the scope of 605, but I think it.
But you're making a payment to somebody for revenue items.
I don't think they're revenue items. Yeah.
Scott?
I'll stick with issue 1 for the moment. I think the paper sets forth the right principles. It is judgmental. There is, I think, going to be a lot of difficult analysis here. I think perhaps the helpful thing to mention for U.S. GAAP practitioners is that when you're trying to assess whether your tooling activity or your NRE delivers something to the customer, don't look to 34010. That's cost guidance. Even though it's written, I mean, the words have some revenue-ish guidance there. And part of that is because the auto industry, the auto suppliers, do not believe they are in the business of selling tooling. Even if they have a contract to sell tooling, they do not believe they are in the business of selling tooling. And 99.5 was written largely with that industry in mind. So it was kind of accepted that those aren't revenue elements. And that's why I think it's written that way, having written the issue paper. But I think that the important thing for U.S. GAAP practitioners is that when answering this first question, don't look to 34010. Even if it sounds like it has relevant guidance, it doesn't.
And Jim, just quickly to follow up on your point, I've heard similar to Mark the point about accounting for reimbursements not as part of revenue. Just an additional argument that I've heard is because the 34010 guidance would suggest that in order to be eligible to capitalize, you need to be expecting a direct reimbursement from your customer. So I think that there's a correlation that companies see in terms of, well, the guidance here is telling us to capitalize because we have the ability to get direct reimbursement for these costs. And so I think that they view the cash inflows that are providing that direct reimbursement as being an offset to the expense. And there are some other areas in GAAP where we do see offsetting of expenses from time to time. So just trying to provide an additional piece of information.
Struggling now, sort of general model for everything, how that would be any different if a service provider said you'll reimburse me for travel. I guess still billed to your customer. Is there a practice of the net billing line item getting allocated to various expense categories before coming up with margin? And I would have thought likely no. But.
And absolutely appreciate that point, and I think there's a debate. But just to make clear that I think that has been existing practice, and that's some of the arguments that have been around for quite some time.
Others here? Mary, issue.
Yep. So we'll move on to questions 2 and 3. So the next 2 questions relate to the interaction of new cost guidance to pre-existing GAAP. The questions on capitalization of costs are applicable regardless of whether or not an entity determines that the pre-production activities are promised goods or services, because the determination of when to recognize revenue is a separate assessment from whether costs are expensed or capitalized. On question 2, subtopic 34010 provides guidance on accounting for pre-production costs that relate to long-term supply arrangements. That subtopic includes guidance on capitalizing versus expensing pre-production costs. The new revenue standard did not amend the guidance on pre-production costs in subtopic 34010. Because the guidance in subtopic 34010 did not change as a result of the new revenue standard, and the guidance is specifically listed in the scope exception in the new cost guidance, an entity that is following the guidance in 34010 appropriately today to determine whether costs should be capitalized or expensed would continue to do so after implementation of the new revenue standard. Question number 3 relates to accounting for pre-production costs for contracts that were previously accounted for under subtopic 60535, revenue recognition, construction type, and production type contracts, which was superseded by the new revenue standard, and whether accounting for those costs are in the scope of the new cost guidance in subtopic 34040 or in the scope of cost guidance in existing GAAP in subtopic 34010. The basis for conclusions of the new revenue standard explains that the new cost guidance in subtopic 34040 is intended to fill the gap arising from the withdrawal of previous GAAP, including previous guidance on accounting for construction contracts. Therefore, the staff thinks that those costs related to contracts appropriately accounted for in the scope of subtopic 60535 today should be accounted for in accordance with the new guidance in subtopic 34040 when applying update 2014-09. So with that, I'll open it up for discussion on issues 2 and 3.
Allison?
Thanks. There have already been some comments about 34010, so I won't repeat any of those. But just thinking about on issue 3, what occurred to me is a question that I'm hearing in practice arise right now around mobilization costs. And I know that there was a reference to that overseas as we were discussing issue 1. And my understanding is that today there's mixed practice around the accounting for mobilization costs, whether they are thought of perhaps in the engineering and construction industry under 60535, they may very well be thought of as pre-production costs or pre-contract costs, and that certainly under certain types of measures of progress, my understanding is that some entities are actually thinking of those as being part of their estimates to complete and recognizing revenue accordingly. So a question had come up as to whether, okay, if these truly are things that are happening before you actually start to build the asset that you've promised to the customer, should those be thought of as something that you ought to capitalize as a fulfillment cost, or are they still part of the performance obligation, meaning that you would, under a cost-to-cost method, attribute revenue to them? Contrast that with perhaps in the oil and gas industry, where there's, I think, some differing views about the cost that it takes to get to move people to be working on a platform, for example, that I don't think there is a view that those mobilization type costs that you attribute revenue to the time spent actually getting those activities in the personnel in place to be able to actually perform under the arrangement. So as I've thought about, okay, we have differences in practice today, how will that survive under the new standard? It seems to me that perhaps there really isn't, and mobilization costs is a bit of a broad term, that it is going to come down to differences in judgment in terms of does somebody really think that the activities that they're undertaking really are part of transferring the good or service to the customer. I could see in some fact patterns where somebody is saying that we do have to set up temporary facilities at a location before we can actually build a power plant. It's contractually specified in the arrangement. The customer is specifically paying us for this service, that someone could conclude that perhaps that is part of transferring the good or service. You're not actually starting to build the power plant yet, but it is part of the activity of performing under the arrangement. I could potentially see facts and circumstances that might allow you to think about them that way, which would mean they're not fulfillment costs. They are just costs to complete the perform or satisfy the performance obligation, versus I could certainly see other situations where somebody might be calling something a mobilization cost, and that mobilization cost truly is something that isn't part of satisfying the performance obligation, and that you would have to apply 340-40. So I just wanted to make the staff aware that there's questions around mobilization costs, but I do think it ultimately will come down to facts and circumstances.
And I think a key distinction there is, as you point out, the term is used quite broadly. Before you even get to the question of identifying performance obligations, you'd want to look to, are those mobilization costs part of you've already entered into the contract and you're obligated to perform them, versus something that you're performing in advance in anticipation of having a contract before you even have any enforceable rights. So that might be kind of a precursor to that analysis.
On question 2, I think that the staff's answer is certainly the right one. I suspect there are some companies that will wish that wasn't the answer, because the capitalization threshold in 34010 seems higher in certain circumstances than the capitalization threshold in 34040, so some might wish that they could jump over. but I think the staff's answer is correct. The staff answer to question 3 I find a little bit odd. It's easy to apply that answer today, but what about the contract that gets entered into 15 years from now? In order to figure out whether you're in the scope of 340.10 or 340.40, you have to think about whether you would have been in the scope of 605.35 15 years before, which you might have been in middle school when that applied. So I find the answer to question 3 to be fine in the short term and meaningless in the long term. I don't know what to do once we get out a few years. My solution to both the angst some will feel about being stuck in 340.10 and how you would do this analysis years later is delete 340.10. It was written for a specific purpose at a time when we didn't have other guidance, and I think the reason why 340.10 was written was because everybody acknowledged that normally you wouldn't capitalize these costs, but gee, what if you have some level of promise of being reimbursed? And frankly, I think the threshold in 340.10 is receivable. I don't think the asset is anything other than a receivable, even though that isn't what it normally gets called. So I actually think we would lose nothing by deleting 340.10, and we would eliminate the need to ask questions 2 and 3.
I think that's a fair assessment. I think it addresses the concerns I think both you and Brett had earlier too. There seems to be some revenue type thinking there. You have to ignore that. It sort of feels like look to revenue first, even though the words here might be written a little awkwardly after 60, compared to 606. Why do we need 2 thresholds? At the risk of other board members saying terrible idea, I actually wonder if it's not a bad EITF issue. Just a guy, either a tech correction if we thought it was that level, or a bad EITF issue. But others may disagree. At least one board member gave me a thumbs up, so I guess.
Deleting something without adding anything else sounds like simplification. I'm just saying.
Most simplification's not well received.
Ian, I think that has exhausted topic 2.
And 3? Topic 2, yeah. Okay, so I think on issue 1 we had sort of broad agreement that the guidance was good, but a concession that there's going to be a lot of need for judgment in those issues. It's hard for me to comment on questions 2 and 3, except that I'm glad we've got principle-based standards as a general comment. But I guess you came to your conclusion over there, Jim, and it's you're going to delete 340.10, am I correct?
Well, I don't know if we have that. I don't know. I think that might be the consensus advice.
Okay. All right. Well, I think if we leave it there, we'll have a break till 5 to 3, quarter of an hour break, and get back on to issue 3.
Sounds good.
That's me. Okay, thanks, Jim. So US GAAP currently includes revenue guidance for the gaming industry that addresses the accounting for fixed odds wagering contracts. That industry guidance will be superseded upon the effective date of Topic 606. Because Topic 606 does not include guidance similar to current US GAAP that specifically identifies fixed odds wagering contracts as gaming revenues, some stakeholders have questioned whether fixed odds wagering contracts are within the scope of Topic 606, or whether those contracts should be evaluated as derivatives in accordance with Topic 815. This question has arisen in part because in 2007, the then International Financial Reporting Interpretations Committee considered a submission related to the accounting for wagers received by a gaming entity. The IFRIC did not address the issue, but noted that fixed odds wagers are financial instruments that likely meet the definition of a derivative under IAS 39. The FASB staff does not think that it was the board's intent to exclude fixed odds wagering contracts from the scope of Topic 606. Rather, the FASB staff thinks it was the board's intent for fixed odds contracts to continue to be accounted for as revenue transactions. So the question for TRG members are, first, did TRG members agree with the FASB staff's view that fixed odds gaming contracts are within the scope of Topic 606? And if so, do TRG members think the guidance is sufficiently clear that fixed odds gaming contracts are within the scope of Topic 606? With that, I'll turn it over to the TRG.
Allison.
I would say that I agree that it makes sense that the contract should be accounted for within 606, but I think it's difficult to find support for that view based on the guidance as it exists today. So one question that I had was whether the FASB would consider making a technical correction to make it clear that these types of contracts would be in the scope of the revenue standard and would not apply derivative accounting. It seems as though that would certainly clarify the issue for those entities.
Along the same lines as Allison regarding clarity, I think the question is whether they're within in the scope of Topic 815. In the past, we had some guidance that was on point that made it easy to conclude they weren't in 815. Now we don't have that guidance, and the revenue standard doesn't include things that are covered by other topics. So I was having a hard time figuring out why it's in the scope of IAS 39 or IFRS 9 and is a derivative, yet it isn't in the scope of Topic 815. The definitions, of course, aren't exactly the same, but I couldn't figure out which difference in the definition caused it to be excluded from 815 in the U.S. So I'd prefer some clarity on it. To the question of whether it ought to be covered by 815 or 606, I'm not sure I agree that 606 gives the better accounting. It certainly gives the accounting that's more consistent with prior practice, but if the casino is on the hook for huge bets that it accepted with odds that now look like they'd rather not have accepted those bets, maybe it'd be a good idea for them to mark that to fair value. So I don't know what I agree is the better answer. As for what the board's intent was, I'll leave that to the board members. But if their intent was that 606 should apply and not 815, then let's just put something in to make that clear.
So with the...
Yeah, but we don't necessarily agree with that, Scott.
The IASB is back.
Ian, we had started on the last issue because it's more of a U.S. GAAP issue. We're happy to go back and join with you on issue 3 if that's where you're at.
We're not anywhere at the moment, Jim, so why don't you continue with issue 4?
Okay, we'll just finish this discussion. Brian?
Yeah, I think to maybe reiterate what some others have said is that now, we think with this guidance, like other industry-specific guidance, has been superseded. So now you just apply GAAP, and you would, absent some technical correction, need to evaluate whether they're derivatives or not. I can't speak to whether I'm not a derivative person, so I don't know. And if that, I think to Scott's question, I think it is kind of a interesting question. If I place a fixed odds wager that the Cleveland Cavaliers are going to win the NBA championship in the fall, and LeBron blows out his knee, I mean, why wouldn't 815 give the better accounting answer? I'm not sure why we're leaping to, well, let's wait until they lose in the first round.
Yeah, I guess including in that, and I'm not saying this is worse accounting, but presumably taking the day one gain for sort of any VIG that you might charge, or I mean, it's a question of, and then I guess again thinking whether you want sort of the revenue disclosures or derivative disclosures, including for table games that, of course, don't have the same feature. They're closing out immediately, although I guess they would be in the scope of still the derivative disclosures in terms of volume of activity and gross flows, and whether that is sort of a more useful presentation to investors versus treating these as your revenue line item. Because the other interesting thing would be, as I understand it, I think casinos in the U.S. so tribal nation financial reporting that might fall under GASB reporting, I think, is accounting for these as revenue. I don't think this would change the scope at all of GASB accounting, and I think in some circumstances the same entity has to report both under GASB standards and FASB standards. So whether that would be sort of a useful exercise for them to need to keep two sets of books and records and report, again, all of which we might want to look at. I just not clear to me that that's what the board wouldn't hear when we debated the issue, but whether that's what we sort of intended. Brett.
Yeah, just to maybe add on a few thoughts. That's what's already been said. I think it was also the board's intent to try to eliminate industry practice and to converge with IFRS, and I think so. Sort of following what intent is difficult, which is, I think speaks to the need to probably clarify this area. Sometimes when you say you're no longer in revenue, people think, well, that means I have to present something as something other than revenue. I think that's it's the same thing you tell a bank that's just earning interest income. You're not in the scope of 606. You still have interest revenue, obviously, and so it may be that the presentation isn't very different. Maybe some different disclosures. Frankly, maybe disclosures are less onerous if you're in derivative accounting than perhaps in revenue. I'm not sure. But I think the thing that's worth thinking through, too, is, there's a lot of aspects of 606 that may be difficult to navigate. Like I think it's clear in the casino audit guide that you present your net gaming revenue net, which is what I think the derivative accounting would be as well. I'm not so sure how I would apply the principal agent guidance in the revenue standard to evaluating whether that bet with the gambler is in fact gross or net. I'm just not sure how I would go about that. So, which may speak to having to provide more guidance around. Okay, if you're in 606 and you're a casino, here's how it's going to play out. So, at the end of the day, I'm not certain that. The arbitrage in accounting is just the open bets, the open positions at a balance sheet date. I say just. I mean, I think it depends on how significant that is to a casino. But other than that, I would think the net revenue presentation is more or less identical. Maybe labeled different, perhaps, but just don't think it's a huge difference in outcome. But
I think the timing could be depending on
the timing on open positions. But yeah,
would be.
The other issue is netting the promotional expenses, which would not be done in derivatives accounting.
Well, I think there's a view on the staff anyway that you no longer do that under 606 either.
Right. I mean, by being within the scope of 606, it means you follow the guidance in 606 regardless of what the old industry guidance used to allow you to do.
And there is an AICPA task force that is addressing some of those issues around what are the performance obligations in the arrangement, assuming that the accounting for these types of transactions would be under the scope of 606. So some of those issues are being thought through by that group.
And I guess even if the conclusion is it falls under 815, at least in terms of part of the arrangement or contract, there will be portions for which you'll have to evaluate 606. So you may have two pieces of literature. That is, if you're earning material rights as you're playing at the casino, presumably you're going to have to evaluate, do I need to do some accounting for the comps that are earned as I'm entering into if they were derivative transactions, and is that portion of the transaction under 606? So you have sort of.
Yeah. I thought through that too. I thought actually, like the credit card scenario, if in fact the base transaction is out of scope, then if I'm earning loyalty awards based on more someone's betting, then perhaps that's sort of out of scope of 606 as well. On the other hand, if I'm earning loyalty points because I'm staying in hotels that are owned by the casino, it may be different. But yeah, I think that's.
So then, yeah, I mean, which could not saying it's not the right path to head down, but then a complicating factor of which loyalty, you're earning the same account, whether it's staying at the hotel or eating the food or doing the gambling. So people can do it, but you need a system, I guess, to then sort of track those under two accounting models. Right. Daryl?
I just wanted to understand a little bit better from those who may be advocating some clarity being provided in this area. Just wanted to understand the nature of the clarity that you might be requesting, whether you're asking that there be some clarifying language inserted that would specifically deal with fixed odds wagering contracts, which then I think would beg the question potentially if other types of gray area contracts get identified later on down the road, then we would also then potentially be providing more specific exclusion for specific types of facts and circumstances, or are you advocating that we could provide clarity in a more general, principled way that would help potentially with this and anything else like this that might be identified later?
I was similar to what Scott said. I think that we had thought that absent any further clarification and gap, that people would look at the contract, they would look to other areas of gap like the derivatives literature. And while I'm not a derivatives expert either, our derivative experts in our firm have indicated that they think that they probably would be accounted for as derivatives. So it would seem as though if there's a technical correction to be made, consistent with what Scott was said before, having that technical correction be made in the derivative literature to scope these transactions out of that literature would be helpful, because then you would be evaluating them under 606 and the scope guidance in 606, where you have to think about whether there's other things in the scope of other standards. That other guidance would now tell you, okay, we've looked at 815, it's scoped out, so bring it back around and it's under 606.
Daryl, to your question specifically, I would advocate very specific guidance. Normally, obviously, we want to write principles-based guidance here, but if I boil the staff's paper down to a principle, the principle is we didn't mean to change that. I don't think we can write that principle into the literature, so I think we have to be very specific.
Although I guess I don't know that there's a specific scope exception today from 815 for these, other than a practice, and after that, some guidance developed by an industry group that came after 815. So I'm not sure how that exactly developed either. Mark?
Yeah, to that point, and I think that's what I was going to say. I mean, I don't know whether you amend 815. Maybe you stick it 924, 815, or 606, whatever it is. Just bring it back. What was the language that was in there before might be enough. A little more clarity might be helpful so that we don't have to talk about this in 10 years again. I hear some sort of leaning towards derivative accounting. All of my outreach that I've done to the casinos saying if you want to keep consistent application or consistent financial statements within this industry, we don't want. I would not want to get into a diversity where some are saying, well, this is a derivative and this isn't, and some of these bets are and some of these aren't. I don't think the model that they use today is broke, and I don't know why we would try to break it. So if there's a way to clarify it, I don't know whether this is enough that the FASB said it wasn't their intent to break this. But I guess if you want to go to 815, I would suggest doing a lot more outreach and talking to the casinos and what the implications are. Like Allison said, we're working through it at the ICPA on a lot of these issues. I think we'll get to reasonable answers under the standard. And yeah, some things will change, but making them all derivatives hopefully is not one of them.
The FASB, I don't think, made any decisions about this. They made decisions to get rid of industry guidance and didn't foresee this particular issue. And the staff has made statements in this paper about what they believe the outcome would be. But the FASB's never, to my recollection, deliberated this issue.
Just to add to Mark's point, I do think, as the boards think about it, if the decision is to head towards 815, I think that's probably far more outreaching, and you probably need to do a lot more outreach to determine what are the other unintended consequences of that answer. So 606 sounds like a simple answer, but if the board decides 815 is the route to go, I really would encourage more outreach.
Anyone else? So I would summarize this as more clarity would be useful to you all. Ian, I think that takes us back to issue 3.
Are you still there, Jim?
Ian, can you hear us?
Yeah, now I can hear you.
Okay. So we would summarize in the U.S. issue 4 as people generally looking for greater clarity as to 815 or derivative accounting versus revenue within the scope of 606. I think, Brett, you make a good point, is either way it doesn't preclude you from sort of a top line. But greater clarity is what people were asking for here, which gets us back to issue 3. Scott, I think you're teeing up.
I am. All right. So turning now to issue 3, TRG Agenda Paper 45 discusses a few additional application questions that have arisen with respect to licenses of intellectual property in recent months. The agenda paper is organized into 4 issues. The staff think it would be beneficial to the discussion if we attempt to segment the discussion into first, a discussion of issue 1 about the timing of recognition for revenue attributable to a renewal of a time-based right-to-use license, followed by a discussion together of issues 2 and 3 that are both fundamentally about identifying attributes of a single license versus identifying the promised goods or services in the contract, and finally a discussion of issue 4 that is a more specific application question on customer options to add users, seats, copies of software. Before we jump into issue number 1, the staff want to highlight a couple key themes that run through the discussion of and affect all of the issues in this paper. First, it's important to remember that the licensing implementation guidance applies the model in the new revenue standard. It does not replace it. For example, the implementation guidance about what are attributes of a license or the implementation guidance on accounting for sales or usage-based fees does not change an entity's requirement to identify the promised goods or services in the contract when assessing its performance obligations as part of Step 2 of the model. Nor should the implementation guidance result in a customer option to acquire a license being accounted for differently from a customer option to acquire any other good. The second key theme is that the new revenue standard establishes that a customer does not obtain control of a license before the beginning of the period during which it can use and benefit from the licensed intellectual property. And therefore, the licensor's performance to transfer control of a license to the customer includes not only the requirement to deliver a copy of the IP, but also to deliver or grant those rights, because the customer controls the rights, not the IP itself. In other words, the new revenue standard establishes through paragraph 60610, 5563, which is B61 in IFRS 15, and as explained in BC 414, that a licensor has not transferred control of a license before it has both made available a copy of the IP and granted the rights under the license. These two themes sort of permeate the staff's analysis of what we believe the new standard requires with respect to each issue. So, turning to issue 1, paragraph 20 of the TRG paper outlines what we term example A. 2 parties enter into a 3-year license, the term of which ends on December 31st, 20X3. On June 30th, 20X3, the parties agree a contract to renew the license for 3 more years beginning on January 1st, 20X4. Some stakeholders have expressed the view, which is view A in the paper, that the renewal revenue should be recognized on January 1st, 20X4, which is the start of the renewal period. Those stakeholders think the guidance in paragraph 5563 or B61, stating that the licensor cannot recognize revenue before the beginning of the period during which the customer can use and benefit from the license, supports that view. Other stakeholders have expressed the view, which is view B in the paper, that the renewal revenue should be recognized on June 30th, 20X3, when the renewal is agreed between the parties. That paragraph 5563 B61 speaks to an initial license only because in a renewal of a license, the customer already controls the license. Thinking to one of the key themes that was described, in the case of a renewal, the entity has no further performance to undertake. It has already both provided a copy of the intellectual property and granted the rights in the license because the customer is already using and benefiting from those same rights. As expressed in paragraph 26 of the paper, the staff think view B is the most consistent with the guidance in the new revenue standard. With that, I'll turn the discussion over to the TRG of issue 1.
Comments, questions here? Allison?
So on issue 1, as I was reading through the staff's analysis and the conclusion, I followed everything and it made sense and agreed with the conclusion there. And as I thought about this, the standard as it was exposed with the most recent exposure draft would clarify that restrictions on time, geographic region, and use should be ignored. And so this being a restriction related to time, you ignore that. And so then the accounting model as described by the staff makes a lot of sense. I found myself questioning that, however, when I got to issue 2, and I appreciate that we're not discussing issue 2, but I did at least just want to say that overall, distinguishing situations when time, geographic use are really attributes of a license, and when they really should be thought of as a performance obligation, that tends to be difficult. And we're finding around the globe as we socialized this issue that we're getting lots of different views to both issue 1 and issue 2 in terms of what people think is the right answer. And so again, if we were to peek ahead to issue 2, people might then view issue 1 and say, well, adding an additional time increment, that is granting an additional right. And so that is obviously what's under review A. And, I think people could reasonably come to that view under the standard as well.
So this might be making it, your point, I think, is this might be oversimplifying it, but we seem to be treating time differently in issue 2 than issue 1. We say all of these things are not features of the license, but then when you add one later, we say those are separate, but when you add time later, it becomes a feature of the initial license. Is that and so why is time different?
That's the struggle. And again, with our network around the globe, we're finding a lot of difficulty with people coming to consistent answers.
Brett?
Yeah, I guess maybe a little bit on.
Brad, Brian, it's almost the same.
Who?
Oh. Go ahead, Brian.
All right. So, I guess what I was going to say, you may be along Allison's line, is that the analysis in issue 1 seems a little inconsistent with what the thinking was under issue 2 and 3. Here, the customer, the first license, established a right to use for a period of time. So, an extension of that period of time to us seems like that's outside the scope of the original license. So, in our view, we were thinking the original license had boundaries to its scope of use, and any change in those boundaries subsequently as a result of a negotiation agreement with the customer would kind of by definition be a new and different license. So that would lead you down the path of considering whether it was a modification and so forth. We do like the outcome of that the staff come to in the paper, but we really only look at paragraph 25 of the paper as providing some basis, what is discussed earlier, and in the basis for the conclusion or support for view B, we think that is flawed.
Right.
So yeah, I think we tend to agree with the staff's analysis in the first question. I think we struggled as we got into the second and third issues. And honestly, I think it seems like the standard, or at least as it's being reformulated in terms of these exposure drafts, seem to be sending mixed messages around this whole license area. And I think on probably two dimensions. One is there's sort of a view of, look, I performed and I've delivered the rights and somebody can begin using them. So any of those restrictions that I put on that customer and that licensee are just attributes. They're going to define what the license boundaries are, but I've conveyed the rights to that individual, and they stand to benefit from the risks and rewards of ownership of that IP as defined on day one, basically. So I have that notion about performance, and then I have the sort of notion about conveying value to my customer. So if I'm focused on conveying value because I have to wait for this date, and I delivered the software key or I've delivered the digits, the film or whatever, that becomes an important gating issue, and those two sort of ideas create tension, I think, in the model. And I'd say the other area where I think there seems to be some tension is the license guidance, the either right to use or right to access, coupled with an exception for sales and usage-based royalties, feels like a parallel part of the model. Feels like it's separate from the rest of the model. Yet we keep going back to, well, they could have been distinct, and they could, we keep thinking of them as potentially as additional options or optional purchases. I think the minute you start doing that, you kind of mix the concepts. It's hard to make it work. So I personally wonder if it would be better to sort of figure out which path you want to head down and stick with that path, because right now it feels like the principle that restrictions don't determine performance obligations doesn't jive particularly well with the examples where, in fact, it seems to be driving performance obligations. So.
Are you envisioning a circumstance, though, where are you effectively saying that the board should pick one or the other and there should be no judgment? So time is always a attribute, which means it shouldn't really impact much at all, or it's never an attribute?
I guess I would never say no judgment. I think the point I'm making is either the model is it's all about, conveying it's reporting performance. I perform by delivering you functional IP that's fully functional. I have nothing further to do, and I put restrictions on you, and those restrictions don't really determine anything other than how you're going to use they're going to set the price, obviously, going to affect the value, but you have the rights immediately. There's sort of that model. Or there's a model that says, no, I'm looking for value to it's sort of like an operating lease model. I own the IP still, and I'm just letting you use it in certain bits and pieces, and as you use it, I'm going to reflect my performance. That's a different analysis, I think, than the first one. I think the first one's about conveying value, about transferring control over the value on day one.
See, where I get confused there, one of the things we're trying to highlight is, again, whether you agree with it or not, if we had a blank sheet of paper, that's a different story. This has created, and again, this is relatively consistent with TPA 70 today, is that we've said that, giving you the functional IP, let's say in this case, is not when the customer obtains control of the license. It is the point in time at which they can begin to start using and benefiting from it. So in an initial license, whether it's today or tomorrow, the notion is if I've given you a copy of the software on June 30th, and this is not the renewal scenario, this is a new scenario, on June 30th, but you can't use it till 1/1, you don't recognize the revenue till 1/1. I think most people would agree that's pretty clear that that's what the standard requires, right or wrong. And it's those two pieces of performance that differ when we think about the time scenario. It's that distinction that we're drawing. And to be fair, we've had certain discussions with people that highlight that distinction. And the difference is I don't have to grant you those rights. If you view the standard as requiring the granting of those rights, there's nothing new for me to grant if you're already controlling and using those rights. And that's the difference we draw, since people are drawing a distinction between 1 and 2, between issue 1 and issue 2, is that the standard requires that you make available the intellectual property and that the customer can use and benefit from those rights. When I'm merely changing the time attribute of that license, I don't have to do either of those things again. If you have additional distinct rights being granted, you have to do one of those again. You have to actually grant the rights that the customer has never controlled to that point if they are distinct and separate.
So that, and I appreciate, I struggle with this too. I think that distinction is perhaps almost too subtle for human understanding in some contexts. And I'm not, and so I've characterized it as why, and because we said so. I mean, why is time different? Because we said so. Right. Not because we can come up with some outstanding underlying theory, because, of course, you are granting additional rights when you're granting additional time. And those additional rights, if we head down this path, you just say, well, they're different. And I think we can try and articulate the basis, but it might also be, if that's where we head, is, accept the basis is because we said time is different.
Yeah, I think just what I wanted to point out, though, is just the difficulty, the operationality of trying to divine that line, the perfect line. I understand why there's a gating issue around when the customer can begin benefiting from the license rights. I would submit that actually, even if I have a post-dated right, like a sell-by date, I sell a book to a bookstore and have a sell-by date, that in theory the books, I've transferred control, and I think in a tangible world, we wouldn't struggle that much with the fact that I've sold the books, even though I have a 3-month forward sale-by date. So in this case, with IP, we've created this gating issue around the first use date. But I guess the question is, do you want to expand it even further and say, and now I'm going to look into the license and look to and sort of subdivide the license, and that's what's concerning. And I had an example, not in this paper, but one where I shared with some folks around a usage restriction that says, it's not uncertain usage. I spelled out in the license that the customer can use it 1,500 times in year 1, 2,500 times in year 2, and 3,000 times in year 3. And, it's the same IP. I've conveyed it all up front. It's a 3-year term, but it has usage restrictions in each of those 3 years. And I got back answers saying, well, that's just a usage restriction, so ignore it, record all the revenue up front because it's functional IP. And the second answer was, well, I'm going to look to the beneficiary, and the licensee, in this case, can only use 1,500 in the first year. So maybe I should look and model it based on licensee usage, which feels like a usage-based royalty, but this is not uncertain. And then the third answer is, no, you have to actually subdivide that into a 3-year license for 1,500, a 2-year license for 1,000 installations, and a 1-year license for 500. Record each of those 3 licenses on the beginning date of the first, and I just think we're kind of going down this rabbit hole that is really difficult to navigate. So.
Greg?
Yeah, just a couple of comments, similar to what some of them are similar to what Brett had said. I mean, while I can see the conclusion that the staff reached, I actually was surprised when I read this paper because it was not a conclusion that I had been totally focused on. First of all, the reference to existing gap, TPA 71, I think, or 70, has been superseded. So, it's not necessarily clear that you would go back to superseded U.S. gap and provide that as a conclusion. And I also think that a reasonable person might look at this and not get to this conclusion absent this TRG discussion and this paper, because many people that I've talked to in the software industry say, okay, 71 was superseded. We're talking here now about software licenses that we transfer to a client, transfer control. And many in the industry have felt that the extension or renewal of license rights is an action that the supplier or vendor has to take, right? Because in absence of that renewal by the supplier, the client now is in violation of the initial license. Right. So, I mean, I think that it was not totally clear that this guidance.
Greg, hold on just a second. We're getting nuts.
What's clear? Right.
Sorry to interrupt you.
Oh, okay. Okay. I don't think it was totally clear that you would also assume, again, absence of the paper, that this guidance would apply to renewals. The other thing, as was said, I think, by both Allison and Brett, and we have the same concern, is that this conclusion in issue 1 is not necessarily consistent to the other issues raised in the paper. We need to kind of think through that. And lastly, just operationally, as a software provider, this provides a wealth of opportunity for software companies who sign up customers for multi-year term licenses to, whenever they have a shortfall in revenue, just to go out and sign up renewals, not change the client payment terms, not change anything, but just book more revenue way in advance of the effective license period. Now, while that is similar to guidance today, as we said, I think the new standard we should recognize that more licenses are going to be recognized up front, and this type of guidance could potentially be more impactful in the industry.
First, I would say, I agree with the other comments. I do think there's some tension between 1 and 2, but for all the same reasons, I'm not going to repeat them. I did have one question, though, about this example. And we're talking about IP, and it refers to, say, 2 years out, they grant a new license. Oftentimes, that license has been updated, there's been modifications, et cetera. The example is silent to that point. I was just curious from the staff's perspective, does that mean modifications to the license don't really impact the decision because you're getting them anyway, or do you need to consider that, or is that something you didn't want to clutter up with the example?
I think it would be unfair to say that we ran through those different variations in here. But I think implied to this, and some people here have seen our continuing work on the final ASU for this, it would be when you're granting, this is in the context of I'm granting you the same rights. You had a 3-year license and I'm renewing that same license. We get into a different question. If this has all sorts of bells and whistles to it, there's also, just like today, if there's additional deliverables, I'm granting you a specified upgrade along with the promise to renew the license you already have. That doesn't, none of this takes away your obligation to now account for a new multiple element arrangement.
I would just add to it then, granted there probably are examples where you're just extending what you have today, but there's probably a lot more examples where there's been modifications to what you have today, and I think that might even be more like the more common example, so just throw that out.
Others here? Ian?
Okay. Any comments here? Christoph?
Pretty much in line what was said over in the US. I struggle with making different issue 1 and issues 2 to 4, so to treat the time different from other features of the license. I think in particular if you compare paragraph 34 in the paper and paragraph 26 in the paper, the contradiction becomes obvious, and when these are the paragraphs that are supposed to show a subtle difference between them, to me they rather show the contradiction. Because in one of the paragraphs it said that these are distinct separate performance obligations, separate licenses, while in 26 it's something the customer has the access already, and that's why it would be an extension. Now, why is it an extension if it's an extension by time and not if it is one by geography? So I struggle to see the difference. I wonder how the stuff should be applied to licenses that customers receive where they can choose whether there is for an additional seat or an additional period if we start to treat periods and seats differently. I also agree that the license start date as a trigger for recognizing revenue is important. I think a lot of structuring would occur if that wasn't the case, pretty much along the lines of what was said earlier. You simply do multi-year licenses with extended payment terms and get to where you want to be. And that's why I think we need to get to something that treats time in the same manner than other features of the license like geography or other features, or better explain why time should be a different feature.
Thank you. Can I just clarify, Christoph? So would you view, therefore, adding additional time but not changing the underlying rights, would you view that as being effectively distinct, those additional time rights? In other words, I have a 3-year license. We negotiate to add a 1-year extension of that. Doesn't modify the rights at all, just extends it in time. Would you just therefore view that as being effectively?
It depends on what corner you want to go. It depends on what corner you want to go to. But to say extend it by 1 year or extend it by one region, I struggle to find the principle that would tell me that these should be two different things.
Kazu.
Thank you. Well, originally I thought view B is convincing, but the more I read and discuss with my colleagues, I kind of support the view A. It's simply because it's consistent with the standard or guidance in B61 that revenue can't be recognized until you start using it. So it's simply consistent. I kind of disagree with some points in the view B arguments, like trying to analogize that license to a goods, which is a little bit different. If license with a certain term period doesn't fit into model of the goods, because it's a right to use the goods for a certain time. So it's kind of lease of the goods. So I think it's more leaning toward arguing that this license for a certain period is more kind of distinct performance obligation. So, and also I disagree with the argument in paragraph 25. When you cancel the license of the software, you need to uninstall the software. You can't use anymore from that after the cancellation. You need to, if you want to continue to use, you need to purchase again, which is economically makes sense. Or you need to purchase for the extension for that period. You need to wait until that effective date comes, while after you cancel. So there are a lot of some inconsistency or unclear arguments here. So I just need to clarify further, I think.
Emmanuel?
Yes. So like Kaz said, I think one way of looking at it is considering the transaction as a sale of a right to use the license over 3 years. So renewing it is actually another transaction which is selling another right to use the underlying IP. And second, I don't think there is so much a contradiction with what was said about attributes, because my understanding is that attributes are really useful for one transaction, but here we are talking about a new transaction, so time here can still be considered as qualifying for a new transaction rather than an attribute to the first license.
James?
In reading issue 1, I was happy to get to view B if one placed some reliance on modification accounting. But the key thing to me was in 24, where they highlight that time was merely an attribute to the license, and reading that with 26, where the customer already controls. Those to me were the crux of view B. If that's the case, and I know I'm going ahead, I start getting a different sense when I read issue 2, especially in para 34, where we're saying the customer now doesn't control. I think the original license gave them the control, but they couldn't start in a particular jurisdiction. I couldn't understand why geography and time were being treated differently, either their attributes or their rights, and I think that's where the consistency must come through.
Jane?
I've sort of felt some unease about this from going back a couple of meetings. It's not just the renewal issue, it's sort of other issues. I can see that if control switches to the customer and then they do a number of things over a subsequent period, then you have this sort of point of time upfront recognition of the sales. But having read this and listened to the comments again, I'm still uneasy. It's partly because the sort of ability to use and benefit from on the part of the customer seems quite important, although that's not, that's presumably superseded by change of control. The distinction between changing attributes and making no additional promises also seems to be, somehow quite a fine one. And just thinking about this upfront recognition, I suppose my fundamental question is, does this have to be a point-in-time recognition as opposed to over time? So, for example, if you give somebody the right to use something over 3 years, and you therefore can't sell it again to somebody else. So if we're thinking about forecasting the cash flows of the vendors' cash flows, the amount and timing, it just doesn't feel quite right that something that looks like an annuity is just bang, sort of upfront sale. But I think this may be one I've lost on, and I know Henry's explained to me that once if somebody gains control of something and then they can use it as and where and when they like, and that's what happens with things that people buy. But somehow it just still doesn't feel quite right.
Tony,
I probably share a lot of the things that James said. I think if I'm answering question 1 specifically against the principle that restrictions do not affect the number of performance obligations, then I think the logic flows quite nicely and gets to the same answer that the staff did. But I find it much more difficult when we move on to question 2 and trying to understand why a restriction on time is different to a restriction on usage or a restriction on geography. I think somebody in Connecticut said that distinction is rather too fine to be understood, and I think I'm probably in the same camp.
Philip.
Yeah, so I agree with everything everyone's said, which seems to be very consistent. It seems to me that there's underneath all of this, there's a sort of unit of account issue where we're not really sure whether something is a single thing or multiple things, and we're not sure whether time is a divider of things into different units of account or whether geography is a divider of things into different units of account. Obviously, this first example, although it's about point-in-time licenses, is focusing particularly on software, and maybe there's an implication that software might be something that you tend to use on a continuous basis. Of course, this is wider than just software. This would also apply to things like TV rights licensing, where actually there may be big gaps between when you can use something and when you can next use it. And some people have said so far they get the impression that geography is different from time. That's the impression I get too, though I'm not sure what the basis for that difference is. But then I'm also not sure even if time is treated consistently. I think I've seen a suggestion elsewhere that the right to show a particular film every December might be a single license, and yet every other December might not be a single license. And yet there are gaps in both cases. And I'm just deeply confused by this topic.
Andrew.
Thank you. I think I share the unease of others when we look at the time attributes and geographic ones. I can see how the logic in the paper works, and I think that on issue 1, if you were saying that the licensed software is exactly the same as it was before, and all you've done is change the dates in the contract, so the contract goes out further, then based on what the standard says at the moment, it would seem difficult not to be in the staff view. The difficulty I have, though, is when you look at the guidance around time-based licenses. And maybe I could illustrate it by a very simple, a slightly different but very simple example. That I would license someone software which qualifies for point-in-time recognition. It's a 3-year license, and I give them credit. So they pay me 12 months in advance at the start of each year. What I also do is I give them a software key at the start of each 12-month period. Now, if I look at the way some people read this, some would say, well, because you're giving people the key, if I go to B61, B61 says that's something which will block revenue recognition until you give them a key. One thing I have heard from the earlier conversation, though, is the view that that guidance in B61 would only apply for the first key and subsequent keys, because whoever's using the software as a licensee has already got the software and is already using it, then you wouldn't worry about the need for provision for further keys. Depending on the answer to that question, you've got some very interesting structuring issues around. So I'm a little bit troubled by that. I think when I get onto issue 2, I can see a distinction between the two different licenses, and perhaps it is based around the same type of B61 argument, that what you're looking at with some of this licensing that's being provided is that although you've got it as a customer, you're simply unable to use it until you get to a particular date.
But you're the first one that's found that distinction, that you understand it. What was your point again? Can you just make your...
The first one or the second one?
Okay.
The one in issue 2.
On the difference between geography and time.
Well, I'm not sure there necessarily is one.
Okay, so you agree with everybody else.
So I think I agree with others. I don't necessarily see that there's a principle there that means that there's a difference between the time-based attributes and the geographic one.
So it's on the circumstances of issue 1 and issue 2.
Yeah, exactly.
Okay. Philippe.
Well, when I first read the fact pattern, I came to the conclusion that UA was appropriate. Then I paid some attention to the staff's attention, and I was okay with UB. But what Emmanuel said just a moment ago is important, because it is all based on the idea that the customer already controls the rights which are inferred to him by the license. But those rights will end as of the end of the first period. They will return to the licensor, and the new contract gives again maybe the same rights, maybe not different. But this new transaction just changes the nature of this, not the benefits to the customer, but it creates a new control, not the old one. So I think that UA has some merits too. It's not easy.
Mary?
I think it's a different way of asking a question for understanding the differences, and it is a question which is, if we have said that time is an attribute of the item being licensed, then how can it be that the customer already has control of the item when it has received the item that ends, with the original license term? If time is an attribute of that item, then they don't have the item that includes the extension. And I'm not trying to ask existential questions. I'm trying to see, are we being consistent with our assertion that time is an attribute of the item? And if not, is that maybe the reason that people are struggling with trying to see the difference between the first question and the second question? I also noted a difference that I think somebody else picked up between the analysis in paragraph 24 applying the modification accounting guidance that just says on the last sentence, next to last sentence, a renewal or extension is not a distinct good or service. Well, in the geography, the conclusion is that it is a distinct good or service. And I know we're just discussing the first one, but understanding why that different conclusion is reached about something being distinct or not, I think would be helpful for people in terms of seeing the difference between time and geography.
Gary?
Just somewhat simplistically, Mary, on that last point, I guess it's saying that in the second example, one can evaluate the contract as containing distinct geographies. Mm-hmm. Therefore, if you have one geography and you add another geography, you've added a distinct right. In the time example, you have viewed it, that the model with a right to use license is viewing the period of time as having really no impact in terms of the pattern of revenue recognition, but the time is just an attribute. Therefore, that was the distinction. You wouldn't have broken that up into separate performance obligations for each of those time periods. And therefore, that was kind of the distinction between the time and the geography.
Would you have broken up the geography?
Well,
I mean, if they'd both been granted at the same
I think
time.
we're going to hear, I'm sure we're going to hear views to say that you have a single license there with restrictions built into it. So that's the tension, effectively, is between effectively identifying what are the separate promise goods and services, the performance obligation, versus what is an attribute of a single license.
But I still don't fully understand why time's an attribute and geography's distinct.
Well, I was viewing the first issue similarly to how Scott was explaining, in terms of saying you're not getting additional rights, you already control those rights, and you're just changing the attribute of what you already have.
So why can't you argue that for geography?
Because I effectively evaluated the contracts containing separate promises in that.
But Philippe would say that you had a 2-year contract and then you get a new contract.
No, I understand that. I understand that
And
argument.
by the way, I would add that where you sell upfront or recognize revenue upfront, whether the contract is for 2, 5, or 10 years, it will not be priced the same way. It will not be the same price.
I appreciate that, but it wouldn't have
So I think
impacted.
probably the time element of that contract creates something which is important in the pricing.
Gary.
And, taking issues 1 and 2 together, I actually have no issue with, in fact, support where the staff is on each one, but only in a vacuum. I think if we can collectively conclude that there is no distinction between time and geography, then we had to pick one. I would probably opt more towards view B, it as opposed, the staff conclusion in issue 2 to be clarified, assuming we think that really time and geography really have to hold together. I think trying to explain this to a non-financial business executive, I think the staff recommendations in both issue 1 and issue 2 are more consistent. I think issue 1, where it's 3 years, sometime during the first 3-year cycle, you extend it, trying to tell an executive that you got to wait till the next renewal period begins to say, well, I'm just continuing what I already had. I could have wrote a 6-year contract in the first instance and booked 6 years of revenue up front. I think that would be hard to be understood. I think on the other hand, when you go to issue 2, when Japan or new product line kicks in a few years down the line, they'll understand, well, it's going to be a few years before I start seeing revenue, or my customer's customer can start using this, and therefore the revenue flows are more consistent with the ultimate usage pattern. I can see that too. So I can see both individually existing. If we decided, because these are highly subtle distinctions that we can't clearly articulate, that the world can grasp and easily run with, so when we get there, I would probably go towards the staff view. In issue 2 is which should say there is no distinction between geography and time.
Okay. Jake.
Thank you, Ian. I think this sort of builds on the point that Mary was making, which is if you say that time is purely an attribute of the license, then notwithstanding what various bits of the standard say, I don't think you should get to a different answer when you just extend a license or you actually sell a license that will start in a few years' time. If you're saying this is just an attribute of the license and they have everything else they need to benefit from that, then control has transferred. So why would you, in principle, end up in a different place?
Jane?
I'm sorry, I didn't put it down.
Philip.
I was just going to respond to something Henry said a moment ago about the extension of time not being distinct. I think it's only not distinct because we're kind of invoking the sort of series idea in para 22B. I mean, actually, since we're apparently granting term licenses, it seems as though individual terms are perfectly capable of being distinct. So it doesn't seem a compelling argument to me to say that that's a different thing in nature. It's not really. It's just that we're tending to stick them together for convenience a lot of the time.
Lee, I didn't see you down there.
Yeah, I just thought it would be worth putting
a point across, because we don't often in IOSCO get opinions one way or the other, and I think this paper is one of those instances where it's certainly with issue 1, A or B could be supported, but the real distinction between that and the others was not necessarily clear to everybody. So I think I would like to support the discussions that others have brought to the table, which is if there is that distinction between view A and B on issue 1, the rationale for why that's different to the others would require a bit of better explanation if we were to be able to enforce it. That's all I have to say.
Thank you. I think that's it, Jim.
We had
just about had everybody on that one.
We had a couple more comments here, Jim Schnur and Alan Cohen, I think.
I think part of the issue here is that the point-in-time model actually seems to ignore time, and therefore, once you gain control, or the customer gains control, time is not an attribute anymore. Whereas when it comes to something like geography, so if I give Furious 7 to Netflix, for example, to use, and I give it to them in France and Germany, if it's the license period starts and ends at the same time, well, they have the right to use it, it doesn't really matter. If in France they have the right to use that license for 2 years, but in Germany their license doesn't start to 2 years out, should I be recognizing all that revenue in for Germany when they have the product? They're not going to return the product that they got from France to me. All they have to do is put it on their server for Germany, but that license period hasn't started yet. And I think that's the tension here. It's this point-in-time model we have that's causing a lot of these tensions.
In terms of looking at this particular issue, I think it's when you have a situation where you have, let's say, where you have a distinct license, you enter into it for, let's say, a 1-year period. Let's say 6 months later you go out and you renegotiate, and it could go to a competitor. So instead of going to Netflix, it goes to Amazon. The idea that if you renew with Netflix, you get immediate, but if you go to Amazon, you have to wait until that period starts, just doesn't seem to make sense.
My listening to the conversation is I think there's a lot of moving parts where people are trying to put it all together. But listening, I think the key point is we've talked about restrictions as the point that overrides the rest, other aspects of the model. And we've said that restrictions are aspects of defining the rights in the contract. It would seem to me if you change your restrictions, you've got new rights. If that's how we're going to be describing restrictions, whether it's a point in time or otherwise, which would suggest that it would not be that you would treat them similarly over time. And that would be the issue 2 conclusion for issue 1. It seems to me anyway, part of the problem is exactly what Jim said, that there isn't a well understood principle here. And I've heard a number of TRG members request that there be one, but we don't know what that principle is such that everyone could follow it. I see Larry making a face, but I couldn't tell you exactly what the principle is such that everyone could understand it. And so if we focus specifically on issue 1, whether you're in the A camp or the B camp, there's a lot of structuring that could go on either way. So the staff happened to support view B, but a number of you said, well, that would facilitate a lot of structuring. There's a much easier structuring opportunity if you follow view A, which is when you get 1 year into a 3-year contract, you just modify it. You cancel the contract and you enter into a new contract for the remaining term plus. And that gets you to a totally different answer. So I guess it's a long-winded way of saying I'm not sure there is going to be a perfect answer here. And I don't think there is going to be an answer that everyone conceptually agrees with. I think it's going to boil down to trying our best to make sure that there's consistency, if we stick to issue 1, that there's consistency with respect to applying this issue. And one way that we can do that is to have an example in our final ASU that says this is what the answer is. And we can debate whether that's right or wrong, or should be improved, but we could at least get consistency in applying the answer.
There's one thing, the funny part is as we have this discussion, hopefully I'm not speaking entirely over Henry, but as we go through this, it's not like we as staff had any impression that writing this paper would have a unanimous kumbaya moment because of what Cullen was more or less saying here, that there are ways to look at the principles. But there are a couple things that I feel like aren't getting drawn out, and that probably means that when we drafted the paper, we didn't draw them out enough, or they weren't getting hit on. They at least we're trying to circle around. We have been pretty clear whether it's in the issued guidance or whether it was in the exposure draft. And again, the exposure draft, people shouldn't assume that the drafting in the public exposure draft is what will be in the final ASU. Things often have a way of changing based on the comment letters and other feedback we get. But the point that was always being made is that restrictions of a license are attributes of that license. That does not change the fact that, first of all, just logically, you're going through the performance obligations guidance to first figure out that you're even going to the licensing guidance. You have to have identified that there is a promised license before you're going to go to the licensing guidance at all to consider what it says about restrictions of a license. So one of the struggles we had is there is a tension. Somebody mentioned, I think it was in London, about the unit of account issue. You're absolutely correct. People are saying, oh, well, restrictions of a license don't matter. That's absolutely correct. But that assumes you've decided that the entire contract is a single license. And that's sort of what has been a tension point in discussions with many people. Taking the examples in issue 2 is that you might conclude that there are 2 licenses there. So yes, the restrictions on each license don't affect or change those promised goods or services, but it does not necessarily go in order. You have to look at, we have pretty clear step 2 guidance that tells you to think about the promises in the contract. And there is some tension there. Can a reasonable person come through and might say, oh, well, that's a single license with restrictions? But is that necessarily the only answer? The only answer we've heard, no. So there is a question about thinking about restrictions of a license do not affect that license, but that paragraph doesn't tell you how many licenses you have. One of the other key distinctions that we were trying to draw, just again, not to say that the distinction was either right or the way it should have to be applied, but just because it's clear, one of the distinctions between time and the geography, the defining distinction we came up with is that differential performance, and is that notion that, the standard includes the notion of providing a copy of the IP and providing, granting those rights initially. And in our view, when you took the Europe-Japan type scenario in issue 2 and you took the time renewal scenario in issue 1, there was a difference there. That was a difference we could grab onto and say, here's what the difference is. I have given you everything you're going to get under the time scenario. I have not under the geography scenario. You can poke holes in that, but that is the distinction we saw, and I want to make sure that's clear. Whether you agree with it or not, that was the distinction we saw.
And I think what I heard is people are struggling to understand that difference. And so you've told me that same thing for 4 or 5 months now, and I still don't understand the difference. So I'm not sure reiterating it is necessarily going to convince us. And I get the theory. I think people, and I heard it relatively unanimously, whether you think it should be A or B, people struggling with why is time different from other attributes. And I think that's the fundamental struggle people are having. And I think if we're going to head that way, as opposed to trying to say it is so clearly different, it's just saying it's different because we said so. Now, I'm not saying that's the right answer to do it, but I think we'd be better off, as opposed to explaining a theory, just saying you treat time differently because we said you treat time differently. Scott?
I'll be the first to be somewhat supportive of the paper, perhaps. I think I can do this. I think I can see the difference. I can apply these answers, and I can explain to an individual person why his or her situation gets the answer that's laid out here. I think Alan has identified and stated why time is different, because we have this model where we have to decide whether it's over time or point in time. And so time has already affected the way we analyze these things, regardless of whether there is a time limit in the license. That is to say, even a license with no time limit, we will consider whether to recognize it at a point in time or over time. So we've already kind of taken time into account once, and when it's also an aspect of the license, it makes it hard and confusing and difficult. So I understand why time might be different, and I think I can apply these answers. I don't know if they're the best answers that we could come up with. I think I could also apply the other answer to issue 1. And to Cullen's point about structuring, I'd have thought that a modification that lops off 6 months under the original contract and then adds it on to the renewal so that there is, you continue to use it for the same year that you already had the right to, I'd have said, no, that your modification is adding the second 2 years, not not lopping off the 6 months in the first and adding that to the second as well. So I wouldn't have allowed that structuring to achieve the goal it's apparently intended to achieve, if you went with that view. But I think this is doable to some extent, Jim. I think you're right. Maybe it's a matter of it's different because we said it's different. Same reason why royalties on licenses of IP you don't estimate, because we said you don't estimate. I was on a panel with PK a few months ago, and he said the same thing. He said, stop asking why. We have no answer for why. It just is. And maybe this is one where that's the way it has to come down.
And I don't mean to come across as negative when I say that. I think you've explained it. You can get behind that, but if you can't accept it, it's because we said so.
Well, the alternative, though, would be to rewrite the restrictions language and don't put time in that listing. We say restrictions of time, geographical region, or use are attributes of the contract. And regardless of whether it's recognized over time or at a point in time, it says there. It seems to me if we're going to treat time differently, we have to take time out of that list.
Or maybe what we mean is that a time restriction that limits you to certain portions of the year is an aspect of the license, but a time restriction that cuts you off forever, well, that's different. And when we change that, that is another item.
That sounds like complexity.
Oh, and it's easy now.
Right.
Maybe in part to respond to one of the comments that was made about changes to contracts. I think it's important to also remember we're talking about the scenarios where there hasn't been a change, but there's a restriction built in that might affect my use of it. And, it's a pharmaceutical product that I can begin using in a specific geography at a specific date. Maybe time to coincide with when the regulatory approval will come online, or something like that. But there are also, all sorts of indications that it might be used for, and that might be changing during the course of a contract. So the need to think, as we think about these things, I'm not so concerned about the modifications and how we deal with those. Obviously, that's a knock-on implication, but it's also the base contract that has restrictions that are not the same throughout the contract, which is. I'm reading the signals right from the staff in terms of what's been in the fatal flaw versions of the U.S. exposure, the U.S. Amendments, where you have Class A and Class B products, and the beneficiary can begin using them at different dates. I guess it concerns me because I don't know how far to take that. I mean, if those Class A and Class B products are, say, an iPhone 6 and an iPhone 6 Plus, does that matter? Does it matter to the licensor that the licensee has, is using it in a different way in a different period? Does that really matter? And we can debate this, and people have different views on it. But at the end of the day, when do those restrictions really determine a separate performance obligation? And I think, I guess I would suggest if there's no ability to to figure out what the principle is here, I think trying to do it by examples is just never ending. I think we'd be better off just stopping and just letting practice deal with it, however it deals with it, acknowledging that it may be diverse, because I think in a lot of sectors they want to treat restrictions as just elements of a contract and not start to break apart an individual license.
So your last point, and I do think, regardless of this discussion, we're going to have some level of diversity in practice unless we go through every one of those iterations, and you wind up with then the potential for conflicting outcomes. And so I think your point about letting practice deal with it has largely been what happens today in many areas, particularly outside of software, where there isn't even a structure that provides the starting point necessarily that we have today. So just keeping this in the frame of reference of at least we have a starting point. I think we can think about whether this improves it, but it isn't a wide open field. And I think we're talking about, can you get sort of a theory for whether time is or isn't different and why, but that we're still in, at least my view, a much better spot than we have in licensing sort of across the board today. So keep that in mind as a frame of reference. Mark?
Jim, I think you just made the point I was going to make. I want to be careful that we don't go backwards. I mean, this license area, I feel like we take 8 steps forward, a couple back, 4 forward. But like Scott said, I think I know what to do here. I think there's not going to eliminate all the diversity. We're still going to have that. There's still going to be a lot of areas where we might have very similar transactions with different outcomes, but I think it'll be a lot less with this or something, whatever clarity you can provide. And as long as we can move in that direction of limiting the diversity, I think that's sort of what we're all trying to get to. Right now, I've seen both view A and B on this topic, and I really can't articulate why one or the other you can or can't do. I think this makes it very clear what you do. So, and same with issue 2. So I think we should hopefully move forward with this, maybe provide more clarity later if there's some outrageous transactions that we're getting vastly different answers, but I certainly support moving forward with this rather than backwards.
I guess I'd sit here with a little bit different perspective, and that unlike many people sitting around the table have not followed this from every minute over the last 10 years, from the pre-exposure draft through the exposure drafts and the basis of conclusions for which there's been references right here, but I'm seeing this more from the private company perspective and the preparers of the financial statements and the auditors of those financial statements that have not had the privilege and opportunity to be around through all these discussions. And I see people that have been here struggling with it. And I'm concerned with respect to if it's supposed to be a principles-based type standard, and yet we have certain aspects for which we're struggling to come up with a principle that's consistent, how these smaller firms and smaller companies without the resources are going to respond. And so, if I'm kind of in the camp, if we can't come up with a principle, let's just say that we're unable to come up with a principle, and this is the rules, and this is how we're going to do it, and quit asking as to what the principle is because we don't have one.
So we talked about issues 1, and I don't know if we've covered people's points on 2, but I think.
Jim, I've got one more comment over here. Jim, I've got one more comment here, if I could.
Sure.
Yeah, I'll be brief. I know a lot of this discussion has been about why are these different, but I'm coping less well than most other people. I'm not even sure I know what I'm supposed to do. It's not a question of why I'm doing it. I'm not really sure what I'm supposed to do, particularly when I think about time, particularly when I go beyond software into other licenses like film licenses, TV rights, that sort of thing. So I'm just genuinely confused, and I don't find any of the answers in the paper particularly objectionable, but I don't have great faith in my ability to get to the same answer as other people. So some more help would be much appreciated.
On to.
I mean, to some extent, issues 2 and 3 were always related. I feel like we've talked about issues 1 through 3. Would anybody, and we can ask them, do you feel like we just talked about 1 through 3, or did we talk about 1 through 2? Is there more? I guess I don't know whether we think we had planned to tee it up one way. In hindsight, the 2 issues were related, so we talked about them together. So I'm just trying to figure out where we are. Does anybody have any other comments about issues 2 and 3 if I was to assume we're going on to issue 4? There's no one here.
So just before we move on, I just did have one observation or perhaps a question to the groups here and in the US. As we had that discussion, I felt most people started, their core concern was difficulties in distinguishing the time case from the geography and use case. And I just wanted to maybe it would be helpful to confirm just how deep that difficulty lies. Were people broadly saying that they agreed with the geography and use case but found it difficult to reconcile the time case? Or were people saying that the tension between the two of them made it very, very difficult to conclude on any of the cases? That seems to be quite an interesting distinction, because if we're kind of there on geography and use and it's really a time issue, that feels like a different outcome from just having a difficulty with the time issue.
So for myself, I can understand the geography issue. I know that's not necessarily what I would have chosen, but it makes perfect sense to me. I don't find it difficult. I then find it difficult to say, okay, now where does that leave me with time? Particularly if I'm allowed to use something for, say, 3 years and then not at all for 2 years and then again for another 5 years. No idea.
Maybe in response to your question, I could get to the answer in the geography case, but I didn't know why the other answer was not the correct answer. And that is where I was battling.
So it's the tension. Andrew?
I think in the geography one, I felt a bit more comfortable with it, probably because I then started thinking about some different industries or different sectors. So, for example, let's say I've got an insurance policy that covers the UK, and then in 2 years' time it will cover continental Europe as well. I don't have very much trouble seeing that as something where I have 2 distinct things. And if I take that back into issue 2, that was something which perhaps I felt a little bit more comfortable with. In terms of the time-based one, I can see how you get to the answer, and I think I can understand the mechanics of it, but I find it difficult to reconcile the way that time works with the geography one.
Tony?
Much the same. I'm still not sure why I'm told that restrictions don't matter and then I'm told that they do. I sort of listened to all of the debate and I'm still not clear why in some cases they do and some cases they don't. I understand how you can construct an argument that you get to the answer you get to for usage and geography, but then I continue to struggle with the time answer in that context. So I'm not sure it's simply the tension between the two. In my mind, it goes deeper than that. And if the idea is that we're going to apply step 2, then I'm not sure we should be told that restrictions don't matter. Maybe the solution is simply apply step 2 to decide whether these are distinct using the principle that sits there.
Can I jump in, Ian?
Yeah, sure.
Yeah, just to follow up on that, I think maybe another way to articulate the same thing is it seems like in issues 1 and 3, you're dealing with modifications to a contract that's already in existence. And in issue 3, the staff is saying, well, follow the modification guidance. issue 1, it seemed like the staff wasn't saying follow the modifications guidance. In issue 2, it seemed that we were talking about things that were in the original contract, but we've deemed them to be distinct based on step 2. So I'm all in favor of following the model overall. And if it's the modification guidance, follow the modification guidance. You still might have to decide whether it's distinct or not. And we still have to come to the conclusion about whether you think time is a distinct element within there. But I think there are, I think that there are spots in the model to look to, and it doesn't have to be as complicated as I feel like we're making it. I don't know if that helps.
I suppose the reason I asked my question, usually I tend to find myself arguing for things that work in theory and don't work in practice. And I was trying to understand the extent to which this works in practice and doesn't work in theory. And I wonder if, to a reasonable extent, it works in practice for geography and use, and the real issue is time. Which is maybe a different way of summarising the issue than just saying it's all open.
Okay, Jim, that's our comments here. I think we're saying we've gone through issues 2 and 3, haven't we?
Yeah.
We're agreeing that.
All right. So turning to issue 4. To some extent, it's important to note this issue was submitted separately from the other issues in the paper. However, the staff decided to include this discussion together with the other issues in this paper, principally because some of the key themes we described earlier also influenced the discussion of this issue. Some TRG members and others have expressed since the TRG paper was posted that the staff do not clearly opine on the stakeholder views other than to say that we reject view C. That is, the staff have not expressed whether they believe view A or view B to be appropriate to the examples D through F that are in the paper that were presented by the submitter. This is because the staff thinks the facts and circumstances presented do not answer what we would view to be the key question, which is whether each user seat is a separate license. As alluded to in the discussion of the key themes, the staff think it should be clear that if a customer has an option to acquire additional licenses, there is no basis in the standard for treating a customer option to acquire a license, whether it's a first license or an additional license, differently from a customer option to acquire any other good or service. Therefore, the key question in examples D through F and similar examples that would arise, of which staff are familiar that there's a wide variety of these, is whether the contract provides for a single license or multiple licenses with an option to acquire further licenses. This question is universally acknowledged as being significantly judgmental under existing accounting, including all of the interpretive guidance that's out there, and the staff think it may be so in many cases under the new revenue standard as well. And many of the same considerations would remain relevant to making that judgment. That is, a lot of those considerations are not specifically linked to guidance that has now been superseded. Paragraph 52 of the TRG paper provides some considerations the staff think relevant to answering that question. An example similar to D through F, the staff are not sure whether the answer would always be that there are multiple licenses or not. But if there are, the customer option material right guidance would apply. The staff rejected view C because we don't think the distinction between whether the customer can produce the copy of the software or the entity must produce the copy is substantive in a multiple license scenario, given the second key theme we described now a long while ago, which is that the licensor's performance includes both making available the intellectual property and granting the rights under the license. If the contract is for multiple licenses, the fact that examples D and E that in examples D and E, the entity does not have to make available any additional copies of the software, does not change that its performance in transferring those additional licenses also includes granting those rights, which does not occur before the customer can begin to use and benefit from them. And that is not affected by which party will produce the copies of the software. So, with that, we'll let the group discuss issue number 4.
This is an interesting issue in this paper, and I think I found myself, my reaction when I read it was, if this is not a usage-based fee in exchange for intellectual property, I'm not sure what is. Meaning, I think it, staff, the model has an exception relates to intellectual property that has either sales or usage-based royalties, and this feels to me like it's a usage-based royalty. I've conveyed the IP, and this gets back to the earlier discussions, right? I've conveyed the IP to the customer, and I have usage restrictions on it that says they can use it for 500 times, whatever, and then if they use it more, they pay more. So it just felt to me like, if I start to think about that, well, it could have been distinct. Sure, it could have been distinct, but that's not the model. The model is it's IP, and in fact, I've conveyed the IP to the customer, or I've done everything I have to do. And I agree with the staff that I wouldn't look at whether, I have to provide a key or that they can do it themselves as any consequential impact on the accounting. So I would simply look at that. I think it's view B in the paper as a usage-based royalty. And the minute I start to introduce, optional goods and material rights into the mix, I don't know where I am anymore, because now I'm no longer in the license side of the model.
So let me see if I followed the judgments correctly, Scott, and try to draw out what you described. I think I might have it. My firm, we're really small. We got 6 people. We buy a license from Microsoft for Microsoft Excel that covers 4 people, because that happens to be what the base license that Microsoft sells is. And then if we would like to install it on all 6 of our computers, we can pay an additional per license fee to be able to use 6 copies of Excel. I believe there you're saying that the option to acquire the additional 2 licenses would be additional goods and services. Contrast that with we have an accounting system that we run to keep our own books. And we have 1 license to the accounting system. However, we can also pay extra to allow multiple users to be able to access that system at the same time from wherever they are to enter time. And there, the additional fee we pay is a usage-based fee if we elect to have the opportunity for all 6 of us to log in at once.
You're asking for my opinion on those. I think that's not. I think we have to back up just a little bit. I think to some extent, what's important to note here is that we just, as staff, weren't exactly sure what changed. There are multiple license scenarios today. There's guidance everywhere that says sometimes you have a site license or a single license, and sometimes you have multiple licenses. Now, when you have multiple licenses today, you have a nice exception that says you don't have to consider the current GAAP version of the material right guidance, the significant incremental discount guidance. We're just not sure, given the same facts and circumstances for the same license, what would make you reach a different decision about what is a usage-based fee, which albeit is not a defined term, we simply say sales and usage-based fees, versus a multiple license scenario today, tomorrow. We acknowledge that if you conclude that something is for multiple licenses, which at least in your first example about the additional Excel seats, or I'll give you an example that I've had in the past where a company has, the number of seats that they use directly affects how many customers they can serve. So they pay a user-based fee for what they do. In that scenario, if you conclude you have multiple licenses, now you are going to have to ask whether there is a material right with respect to the ability to purchase optional licenses. Now, that is a difference because TPA 50 is now gone. We just simply looking at there's such a variety of those fact patterns that examples D through F did not provide, let's say, enough to cover off all the different ways you can twist this. There's a lot of judgment involved in making that determination of single license or multiple license today. There will be tomorrow, we believe. And our point was that if you conclude that there is multiple licenses today, that may lead you to the same answer tomorrow. And if you do, you apply material right guidance just as you would for the option to purchase any other additional goods or services. That's sort of all we are saying through the progression of this. We do not have, a set category of here's the exact line at which you're going to cross over from usage-based fee to user-based multiple license fee. There's just too many varieties of those scenarios to try and do that.
Right, but you act like that determination was being made under current literature, but it wasn't, because we don't care if it's a usage-based fee or additional licenses. We're not going to peek ahead anyways.
There's guidance that speaks to that. If people haven't been required to make that determination, but I'm not familiar with
Scott, your point is, while there was guidance, there was no distinction in outcome, so you didn't have to think about it.
Right.
Mark?
I think this all goes back to issue 1 of the first paper we discussed, and sort of am I in that optional purchase, or did I already sell them the software like you said on the server, and it's there? It's just a matter of a usage. It's already sitting there. Or do I have to, I guess, installing another instance with maybe a gray area? But are there are those sort of distinct? I think I can say if you say, okay, you can use SAP in this at this plant, and we had installed it there, and then you say if you want to use it at some other plant, maybe that's like we go back to what we were just talking about. Maybe that's a distinct good or service in the arrangement. And we say that's view A. And, if it's just adding license, I know it's a fine line, but I think it's just as a fine line as issue 1 of the first paper we discussed. So we said we're going to use judgment there. I think here we should use judgment too. I think in a lot of cases, the example you just said, I don't think you get a different accounting answer, except maybe if you deem the price and material right. But
I wasn't troubled, Scott, by where you drew the line, appreciating that you could have iterations at any level in between. I thought you drew it just personally at a spot where it was relatively clear in my mind, at least. That
I just tried to figure out real-life examples that I actually been involved with. So.
Right. At least in my mind, it was the one you sort of very clearly had, as you articulated it, one license, and you could hook up another terminal or hook up your iPad or however you're reporting your time. The other one is I bought software out of the box, and if I want to use the same, in the old world, the same CD, I got to pay each time I put it on another computer, and it's a new license, I think.
Yeah, I think our reaction to the paper was that it seemed nonsensical to us to conclude that, hey, every time I might use software more, it's no such thing as an option. It's always a sales and usage-based fee. And so if we're trying to think about how we might maybe distinguish, I think we've talked elsewhere in this meeting and on other occasions about focusing on what is the present enforceable right of the customer to use the software, and what is our enforceable right to payment under the terms of the contract. And if under the terms, it appears that the customer would be making an independent purchasing decision to expand the boundaries of its right to use the software, then to us that strikes us as an option. If instead it's a circumstance where they have the right to use the software, but due to circumstances outside their control, for example, transactions that are run through the software, or actions by employees just downloading, more of the software, and as a result, the customer incurs an additional fee, then that would seem more like a usage-based fee, and there could be some judgment, but I think concluding that, for software there's no such thing as an option, just doesn't seem consistent with the principle. I'd be like, wow, what a great industry, that's awesome.
I just wanted to mention that in looking at this, I had thought similar to what Brett had said. I would have gone with a view B type approach, but as I reflected back on paper 48, as Mark mentioned, it seems as though there is some consistency in the type of thought process that you ought to go through in terms of identifying options versus variable consideration. So just wanted to indicate that kind of combination of what Brett said and then what Mark said, I think, would make sense for us.
Yeah, it's interesting to take these issues today in totality. There is an example in the optional goods paper around a delivery of a machine with a usage-based fee that concludes that since I already delivered the machine, the usage-based fee is just variable consideration. So now I have the same construct in my mind, at least as I think about licenses. If my view is, look, I've delivered the license, if software in this case is a license and I've delivered it, then I'm done performing. There might be some incidental thing I have to do with the key, whatever, but I'm probably not going to look at that as terribly material in the context of the contract. So I've got this delivery of the IP, the customer controls it, and now there's a usage fee that's being paid, or in this case, a royalty, or whatever you want to call it. So I think these issues all sort of, if you think of them together, if that license is in fact already been transferred to the customer and they're just defining usage now, and that's going to define how much they're going to get, then if you're informed that way, if you think of that additional usage as just a characteristic of the license, then it puts you more in the usage-based fee sort of mindset. Again, it's also sort of down this path of it's a separate model, right? I have a license model that has these exceptions, doesn't treat it as variable consideration, it treats it as a when earned fee.
But what if it's usage in the U.S., but they have to pay this additional fee in Germany and it doesn't come into effect until 2 years later? Would that be different?
If you had your principle is I've already delivered the IP, these just characteristics of usage that I'm going to put on the customer, then I think it falls in line. It's just a usage. It's another form of usage-based fee. It happens to be a big one in that case.
Ian, over to you.
Okay. Anybody got any thoughts on issue 4? Philippe.
I really struggle to see any economic difference between the 3 examples. It seems to me that the only difference is how much the vendor retains in protective rights to make sure it will be paid. But all the other economics seems to be very similar. So I reach a conclusion that view C, which makes a distinction based on very formal aspects and not on substance, probably doesn't work. So between view A and B, it's not easy.
Further comments? No, we don't have any further comments here, Jim. So I'll be interested to listen to your summing up.
This is going to be a fun one. I think as it relates to the first 3 issues, there was a struggle to see, even I think as articulated, and I think maybe small differences, but whether or not there was a big enough economic distinction between time and other restrictions. I think Tom had a suggestion as well. We talk about them all the same, but then the accounting treatment appears to be different. And I think people at least are conceptually struggling with that, although the discussion that occurred right toward the end of, is this really a conceptual issue versus we understand the outcome? So arguing for why is it conceptually different and just being clear as to here is the outcome. So I think incorporating that into at least our process, we still have the ability as we're finalizing licensing to figure out can we provide some of that clarity, particularly either through the examples or absence thereof. But what I heard, I guess, broadly is people are at least, at a minimum, trying to understand the difference between time and other restrictions. Fourth issue in that, and I think that really, whether it's as part of the original license or as a modification later, I think on the fourth issue, what I generally heard is when you think about that in combination with the optional purchases paper, that probably is helpful, at least to many, in terms of thinking about whether you are acquiring additional licenses or whether it is a usage-based fee. I didn't hear, as the staff had indicated, we didn't think, I think people here didn't think view C was appropriate. I didn't hear anyone argue for view C. So I think narrowing the potential for diversity there and providing a framework for the answering of the tough questions is probably a useful thing to capture in the minutes. I think that covers the issues we have for the day. We're going to have a closed administrative session, just talk about the operations of the TRG, to do that jointly. Perhaps you could give us, Ian, just 3 to 5 minutes to, I think we need to shut down the internet and the dial-in lines, or those listening online. I think we'll keep the folks who are participating by phone, but if you could give us 3 to 5 minutes or so, and then we could start the admin discussion.
Yeah, okay, 5 minutes, Jim, that sounds good.
Okay.